Tariffs are bad for growth and bad for inflation.
We're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs.
The prospect of tariff wars that could last is very concerning.
What will be a problem certainly would be if tariffs are on the maximalist side of things.
It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, looking forward to the weekend. Equities down 10% from all-time highs and heading towards a fourth consecutive week of losses as investors worry about policies coming from the White House and President Trump showing very little interest in changing course.
Any chances that you will ban on the tariffs on the aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your mind?
No, not. Look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years.
As the president promises more tariffs, equity futures are finding some relief this morning as the nation's capital gears up to avoid a government shutdown.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So, Lisa, some good news. That move potentially opening the door to tax cuts later this year.
Yeah, opening the door to at least the government functioning, remaining open past the end of the day today. A real question here, though, of what this means in terms of where the fight will get directed from the Democrats to the Republicans, or whether they just have no leverage at all. I mean, they're basically talking about setting up for maybe a fight to Social Security cuts and Medicare cuts and Medicaid cuts and things of that nature later on this year. We'll see. They have to get their party together because they're facing a lot of dissent as well.
That's the politics. As for the economy, I've got no idea where the economy is going to be a month from now, 2 months from now, 3 months from now. This was the first week. I think this was a really important week. Never mind all the speculation about what might happen, what might not happen. Delta Airlines coming out and saying the damage is done. The damage is being done. That stock, that name is down for 6 consecutive days. And over that period, it's down more than 20%.
And it's the pace of declines, the fact that we saw it really pick up mid-February. And as Ed Bastian, the CEO of Delta, said, it's been a parade of horribles. And we heard the same kind of tone from JetBlue and American Airlines and United. And Sheila Kahyaoglu came on earlier this week, and she said that they've been seeing it in the raw data. They expected this. So now the question is the data moving too quickly for us to assess it until it's too late? And the market is sniffing that out.
More data a little bit later. You missed consumer sentiment. Very, very partisan, driven by your political party and your political beliefs. But ultimately, it's something the Fed's going to be watching going into next week.
And potentially even more than some of the hard data because of the quickly moving aspect of this economy. If sentiment falls off a cliff, even though it's 500 people who are politically motivated, does that lead to the market reassessing the potential for some sort of downturn going forward? I do think, putting aside Umish and all the hair around it and all of our snarkiness, there is a question about whether sentiment surveys have renewed importance at a time where that sentiment is driving consumer behavior that we're actually seeing and hearing about from CEOs.
Bond yields higher this morning by 2 or 3 basis points. Equity futures up by 0.75%. Joining us this hour, coming up on the programme, Chris Verrone of Strategas with stocks down 10% from record highs. Jessica Taylor of the Cook Political Report as Democrats blink. And Ed Yardeni of Yardeni Research cutting his S&P 500 year-end target. We begin this hour with stocks looking to recover after sliding into correction territory. Chris Verrone of Strategas, a bad company, writing equities are attempting to stabilise in the 55.50 zone. The sentiment conditions are coming together for a rally, but it's usually a day of very strong breadth that screams game on. Chris joins us now for more. Chris, good morning.
Nice to be here.
What a week. What a week. Let's start with that. Are we screaming game on yet?
I don't think quite yet. I think we're in the ballpark of kind of the conditions that we like to see to mark at least some tactical low. And, you know, this last week, again, is a reminder of what I believe is the undefeated rule of Wall Street. It's that attitudes are shaped by price action, not the other way around. And I think in particular, as we entered the year, and we talked about it on this show, the hurdle for 25 would be the game of expectations. The bar was high, and all year we thought the challenge would be chipping away at that bar of expectations. I think we're much closer in that regard today. We've seen just this week a lot of the surveys flip upside down, where you have more bears than bulls in a lot of the investor surveys. You've seen this big swelling in inverse ETF volumes, so people buying the short Qs or the short S&P funds. You've seen the VIX curve invert to a pretty meaningful degree. So spot VIX, how you view vol in the future, should never be above where you view vol down the road, yet it is right now. So you have these conditions that I think are starting to come together. Whether it's 55.50 or 54.50, I don't know, but I suspect we're in the ballpark of some type of a good trading low.
Things are a lot worse than that 10% seems to imply, because beneath the surface, I was going through some of the tech names this morning. Meta down 20% from a record last month, Nvidia down 22% from the highs of this year, Apple down 19% from the highs of December, Amazon down 20% since the start of February. What gives for big tech?
Yeah, not fun, right? Well, I think let's remember a couple things. It's not like DeepSeek happened 6 weeks ago and suddenly tech began to express weakness. Tech, relative to the S&P, peaked on July 10th of 2024. You know what else peaked on July 10th of last year? Dollar yen. So we've talked about this ad nauseum in our work. I think it would be silly to underestimate the impact or the degree to which yen carry for so many years dictated how money moved around the world. And I think in particular, the very large stocks in our index are beginning to see kind of the weight of that. Now, I don't want to forget kind of another undefeated rule of Wall Street. It's that corrections end on bad news. They don't end on good news. If they ended on good news, this game would be easy, right? Markets top on great news and they bottom on bad news. So, as we kind of work through this growth scare, underline the word scare, but I still think it's in the context of a bull market. And one main reason I still feel that way is, despite these kind of very big declines in some of the equities, you really haven't seen an equal response from credit conditions. We did a study this week. We looked at how big is the move in double B spreads off the lows relative to the decline in stocks. So double B spreads right now are up about 30 basis points off their lows, pretty modest. For a 10% decline in equities, you actually historically would expect double B spreads to be about 100 basis points wider. So you've actually seen some relative resilience there in credit versus equity.
Oh, is that signal broken? Is that signal broken because we have a now buffer of private credit that has really shifted some of the credit incoming information from public markets?
So I think no, but let's assume yes for a moment. Let's assume I'm wrong and you're right, and the explosion of private credit over the last number of years is really where the threat or the warning may be. So therefore, I think we ought to look at what these flag holders in the public markets of private credit are telling us. It's Apollo, it's Blue Aloe, it's Blackstone, it's Ares, and you've had good corrections in those stocks, but in uptrends. I think if we're sitting here in 3-4 months from now and these stocks which are oversold have tried to rally and rally tepidly and don't rally as leaders and roll back over, then I think we can kind of begin to move more towards your view, Lisa. But
it's not my view. I'm just presenting the hypothetical, just throwing it out there.
I just think it's interesting, though. Are we really going to get the R word without credit in mass, public credit really deteriorating?
Well, okay, the R word, right? I love that we can't even say recession. Woo! I mean, there's this question of just putting aside recession. There's a question about whether there's been a structural shift in the overall market flows that disadvantages the United States after advantaging the United States for so many years. You mentioned the peak in dollar yen, and that has sort of preceded some of these big moves downward in equities. George Saravelos of Deutsche Bank put out a report this morning titled Pain, talking about how European investors and U.S. equities are down some 30% simply because the dollar has not rallied in tandem with the weakness in equities. Is there a structural shift underway?
We think so. And again, I think that structural shift is dated back to when the most important price in the world began to change, which was dollar yen. It was just congruent with this whole bull market in tech for 12 or 13 years, week in. Now, I think one of the reasons I'm at least longer term, a little bit more sanguine about a lot of this is simply because this weakness in U.S. equities over the last month or two has really not been accompanied with weakness in global stocks. I mean, Europe has corrected here modestly, but it's held up much, much better. The Chinese market has, frankly, held up fantastic throughout all of this. So you're not seeing like the global bear market come together or the global recession come together. Copper is breaking out here.
Sure.
I think maybe one of the most important charts in the world for your viewers, our Chinese two-year yields are now going up. For the first time in 2 or 3 years, you've arrested the kind of financial crisis message from China, which was just bond yields in free fall. That has changed.
It feels like developments elsewhere, and we were talking about this earlier this week, particularly in places like Europe and again in China, are reducing the so-called risk mitigation characteristics of treasuries. It's interesting that you mentioned what equities have done and what high yield hasn't done. I would look at equities this week. We're down again, and bond yields on a 10-year maturity are basically flat. There are days where it provides me comfort. There are days where it really doesn't provide me any comfort at all. What is the 10-year bond yield telling you at the moment about what it trades on and what it doesn't trade on?
Yeah, it's probably been the hardest call for 2 years, and I think we've all wrestled with it one way or another. And the reality is, for 2 years, we've basically been in a range. There's been no rate call. We're sitting literally on the 2-year average of 10-year yields. It's 421 is the 2-year average, and we're basically there this morning. I generally have leaned more bullish bonds. We wrote, I think in yesterday's work, as rates went up on a soft CPI, which is always a surprise, right? We thought the best you would do is maybe 440, 445 on 10s. I ultimately think you will still get a 3 handle on 10-year yields. But there's a pull on the other side here, and the pull on the other side is German 10-year yields look like they want to go to 350, and Chinese yields are going up, and we certainly know Japanese yields. So I think we're kind of in this very unsatisfying moment for global bonds. Again, I lean generally more constructive, particularly on the short end for yields lower. But I just want to make sure I don't get too cute with that call.
Well, just sit on that call just for a little bit longer. Developments in Germany. How big are those developments? How could that change the way treasuries trade? Because typically we think about treasuries driving the global bond market. We don't think about other bond markets doing that to treasuries.
It's funny, I was on your set in early January during Davos, and Christine Lagarde was speaking about how she was peak pessimistic on Europe. And I remember saying to you guys, I want to be a buyer of pessimistic central bankers.
I remember.
Right? And you think about that, why have European equities or Chinese equities, or particularly the cyclicals in those parts of the world, held up better, even as rates have gone up sharply in Germany and sharply in China? I think it's because you have much more accommodative monetary policy, both in Europe and in China. And that's the one difference today with this growth scare that we're going through. This is not the first growth scare of the last 2 or 3 years. It's not the first time cyclicals have corrected, but it's the first time it's happened where you don't really have a Fed that's particularly eager to kind of get back on the easing train. So that, I think, explains a lot of the resiliency ex-US and still a lot of stress here. Like, who gives first? Is it the administration or is it the central bank? I lean towards the central bank, and I think the 2-year yield will ultimately get us there, but that's the big debate of the day.
As soon as next week or too early?
I think that's too early. And John, when you talk about corrections, right, we're down 10. There's a price and a time component to every correction. And when I said, I think we're probably 80, 90% of the way there on price. I do wonder if the time component is almost still in front of us, where we need to just grind this out. Rally, retest, rally, retest. That would not surprise me, kind of given this framework here.
Equity futures this morning, they are positive by 0.75%. Special thanks to Chris Verrone of Strategas, a bad company with a more constructive view, Lisa, about where we are right now.
Yeah, the idea that we're still in an upward trend, even though there are these structural shifts going on. His point about who breaks first. I thought this was really interesting from Bank of America's Michael Hartnett. He said, since equity bear threatens recession, fresh declines in stock prices will provoke flip in trade and monetary policy. This is sort of the bet of some of the upward trend that a lot of people seem to have.
It's the policy response to it. That's why we're seeing so many constructive views on Europe and European equities. As I say, equities are positive this morning by 0.75%. Some developments in Washington we'll get to in just a moment. We'll catch up with Annmarie down in Washington, D.C. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's kick it off in Washington. U.S. Senate Minority Leader Chuck Schumer dropping his threat to block a Republican spending bill. The move opens the way to avoid a U.S. government shutdown on Saturday. Schumer's decision sparking division within his own party. Elsewhere, Russian President Vladimir Putin says he wants to discuss a proposed ceasefire in Ukraine with President Trump. Putin says the truce should lead to a long-term resolution of the war. Trump has started discussing outlines of a final agreement with Ukraine. And finally, shares of Kering are falling in Paris, trading after the company appointed a Balenciaga designer to oversee a makeover of its struggling Gucci brand. Investors had been expecting a high-profile external hire. This kind of stuff is brutal. Can you imagine being hard and the stock drops 11%?
I mean, do they really want to see a sweatshirt that has a sequin on it that costs $2,000?
No, I don't want that from
Or
Gucci
high-heeled
either.
Crocs.
So you're a big Balenciaga fan, by the sounds of it. Yeah? Or maybe not. We'll bring you an update on that story. A little bit later, we'll get more of Bramo's views.
Let's not.
Up next on the programme, Democrats blink.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
Annmarie in the nation's capital this morning. More from AMH in just a moment. She'll be catching up with Jessica Taylor of the Cook Political Report. From New York City this morning, good morning. This right here is a number that Bank of America, Goldman, have been looking for quite a while. 3K on gold. Up 0.5% this morning. That is an all-time high. Lisa, we've never been here before.
And what we've seen is an 84% rally since October of 2022, given the fact that people have been piling into gold for both a safety trade as well as a structural trade, maybe just trying to diversify a little bit away from the dollar.
Geopolitics by gold.
Yeah, exactly.
Inflation by gold.
It's pretty much
the list goes on and on, right?
The all-weather trade. And so here you go.
All-time highs on gold through 3K for the first time ever. Equity futures elsewhere positive by 0.7%. Still poised for a fourth consecutive week of losses, the longest streak going back to August. Some good news this morning. Under surveillance this morning, Democrats blink.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So here's the latest this morning. The Senate Minority Leader Chuck Schumer backing down on his threat to force a government shutdown, saying he now plans to vote for the GOP spending bill to fund the government for 6 months. Annmarie joins us now from Washington. Annmarie, we're calling it a blink. Maybe it is that. But for the Republicans now, they have to focus on one thing. It's what the market wants. It's tax cuts up next.
Yep, this pretty much gives them the green light to focus on enacting Trump's agenda now that they've avoided this potential shutdown. I would agree with you, Jonathan. For Minority Leader Chuck Schumer, this is a blink. Remember, he was at the podium just on Wednesday evening saying Republicans don't have the votes, and the next night saying, well, I guess Republicans do have the votes because I'm going to allow them to vote on this and keep the government open. I'd like to bring in Jessica Taylor now of the Cook Political Report. She focuses so heavily on what is going on the Capitol, on Senate and the House. So Senate Majority Leader has this moment where he says he's going to come out and say, we're going to block this. We are going to make sure we have this fight. And then within 24 hours, absolutely crumbles that strategy. Hakeem Jeffries over in the House and their leadership doesn't mention Schumer by name, but they say in this letter that this is an extreme partisan legislation that will unleash havoc on everyday Americans. How divided are the Democrats right now? Why can't they agree on a single message?
Yeah, I mean, I think it's just that they haven't had a win in so long. I think they're still just depleted from November. And so there was an appetite, certainly among the Democratic base, for Schumer to stand there and fight this. But I mean, the reality is this wasn't going to be a normal shutdown where, OK, there's brinksmanship. Maybe we shut down for a couple of days, a week, everything opens back up. Federal government workers get back pay. What Schumer outlined last night on the Senate floor and then in a New York Times op-ed is that with Elon Musk and Trump trying to cut the size of government and just slash wholesale departments and jobs and different things, that this shutdown could have given them and, Russell Vaught at OPM and different things ways that they could strategically just not open departments that shut down, that they could not give federal workers back pay, that this could give Republicans and DOJ that are trying to cut these departments even more leverage and abilities to do it. So I think that was sort of the actual reality on the ground that set in. But the political reality is that you have a Democratic base that is wanting their leaders to stand up and fight. Remember, these are the people that Democrats need to be giving them money to do a strategy. I mean, it's very plausible when we look at midterm history and how closely divided the House is that the House is very much in play. Now, the Senate is a very different animal because Democrats need to flip 4 seats. The map as it is right now, it's very difficult to get those 4 seats. So, what we're talking about is on a simple majority, this bill was going to pass simply because they have the Republican votes. But with cloture, with the filibuster still in play, this was sort of Democrats' last line of leverage. And I think there is some frustration between the House and the Senate there, too, because, there were close votes in the House, but ultimately there was only the one Republican that voted against this, one Democrat, Jared Golden, and more from a Trump district that voted for it. So, I mean, I think there's frustration among the Senate, too, that, okay, maybe the House should have tried to exact some more concessions and things there instead of kind of, we're now at the 11th hour of these things shut down. The House isn't in right now. All of these things all come to the very end to the to brinksmanship, and there's just not a lot of time to negotiate when it comes down to it.
This opens the door now for the Republicans to really focus on reconciliation. Mm-hmm. What's your timeline for that? Because we're hearing a lot of voices say because of the consternation in the markets on consumer sentiment when it comes to tariffs, they want to bring back some of the good policies that potentially the entire Trump agenda could bring in, which is tax cuts.
Yeah, I mean, I think those are things that poll very well in different things. But when we look at what's happening with tariffs and stuff, too, we saw a poll out yesterday from Quinnipiac University that, yes, voters and Americans are okay with things on China, but majorities are against the tariffs on our allies in Canada and Mexico and different things. And I think, you saw what Trump was talking about yesterday with, tariffs on wine and champagne and different things. But, a lot of red states are going to be affected by this. We're even seeing, Rand Paul from Kentucky was talking about yesterday if the European Union and Canada and things, they are slapping tariffs on whiskey and bourbon and different things, and that's the reality that I think gets lost in these tariff discussions and why, it's not Trump likes these, but it's not a core Republican principle. When the Republican Party was founded on these free trade, has traditionally been a free trade thing because, yes, we can say, we want to protect our things, but we have to export these things too, and we want them to buy things. So when you have Canada that's boycotting buying any American goods and different things, that's going to hurt in red state places as well.
It feels like Trump is in full-on negotiating mode. But back to the tax cuts. Do you have a base case on when we can see them get through? And how are Democrats going to message around this? Because as you've said, this was their one point of leverage this year, and they pretty much just blew it.
Yeah, I mean, I think they want to just get them done as soon as possible. I mean, you want them done in the first 100 days and different things if possible. But, where does it leave Capitol Hill in this fight? I think, once they return from recess in a few days, we'll see. But, that is a way for Republicans to kind of turn this messaging around. But again, Democrats have kind of ceded the ground on this. And so I think that's just where the Democratic base is, and they've have they lost confidence in some of their leaders.
Given how slim the Republican majority is in the House, do you think it's going to be very difficult to enact Trump's agenda? Or because he's basically almost acting like the speaker some days, calling it different individuals, he's going to be able to make those deals and make sure that his legislation gets through?
I mean, they still have the majority, and you have even some, again, conservative Democrats that might even want to cross the aisle to do this.
Because if not, it'll be a tax hike.
Exactly. But, I mean, Democrats are going to message this as talking about, like, who is actually this tax cut going to benefit, the wealthy or the middle class and different things. So, I mean, it's a messaging war on who's winning that right now. And, again, when it comes to tariffs, I think are Democrats sort of content to wait to sort of see the polls sort of catch up where the economic reality is? But right now, I mean, Trump and the White House are the ones calling all the shots. And again, I think that's why there was such frustration that Congress had a way to step up. I mean, they're the Article 1 branch. The White House is Article 2, but it hasn't felt like that recently.
Jessica, thank you so much for joining us this morning.
Thank you.
Jonathan, that was Jessica Taylor of the Cook Political Report. What stood out for me in that conversation is this Quinnipiac poll. Americans like the idea of tariffs on China, but not so much when it comes to Canada and Mexico.
Annmarie, appreciate the update. More from Annmarie a little bit later this morning, 7:30 Eastern Time, catching up with the NATO Secretary General Mark Rutte. Look out for that a little bit later on this morning. As for the policy volatility down in Washington, D.C., it's hitting sentiment, that's hitting the multiple. This was the first week we really started to see it hit earnings. What you heard from the airlines is really important. What you're hearing from BMW is important as well.
That they're getting hit from all sides and they're seeing sales plummet, and how this is really going to feature into their expectations going forward.
Equity futures are bouncing this morning by 0.7%. Up next on the program, Oliver Chen of TD Cowen on the impact of tariffs on retailers. From New York City, you're watching Bloomberg. So these are the scores this morning. Equity futures on the S&P 500 up by 0.7%. On the Nasdaq 100 up by 0.9. On the week so far, though, on the S&P, we're down by more than 4 full percentage points. On course for the biggest weekly loss going back to 2023. Back in March of 23. At the moment, on course for 4 consecutive weeks of losses, the longest such streak going back to August of last year. And beneath the surface, just look at the damage. I went through these names a little bit earlier on this morning. Meta down 20% from the highs from only a month ago. Nvidia down 22% from the highs of this year. Lisa, Amazon down 20% since the start of February. This has been really quick, brutal stuff for some of these major tech names.
It's been a correction in the S&P 500. It's a bear market for sure since the peak in December for the Magnificent Seven stocks, and it's being driven by something other than DeepSeek, other than election fears. You have a confluence, a parade of terribles, to quote Ed Bastian, that are leading to a real softness in equities. And it's raised this question, if this is still part of an uptrend, like Chris Verrone was saying, what will it take to broaden this out at a time when there are a lot of different sort of nodes that are getting a little weak?
It's been a tough week for equities, but check out the bond market. No real movement. The 10-year maturity, the 10-year yield at the moment is totally unchanged on the week so far. The 10-year 4.2929 yields up by 2 basis points on the session and flat on the week, on a week where equities have dropped 4%.
You could draw a lot of conclusions. A lot of people just say it's a mess, don't even try. There is one detail that keeps sticking out to me. We got CPI and PPI, and it's the reverse of what we've seen in the past, where it came in hotter than expected, but the components of it that go into the key inflation metric that the Fed looks at came in weaker than the rest of the indicators. This is the opposite, where basically it looks like it's weakening, but if you look at the underlying components, it really was driven by a couple of indicators like airline tickets that don't go into core PCE. So this doesn't give the Fed carte blanche to cut rates, and that maybe, if you want a narrative, seems to be what people are pinpointing.
Something has been weakening, and that's the US dollar over the last month or so, and you're seeing that against gold. Gold this morning, all-time highs and through 3K for the first time ever. What a move. We're up another 0.4% on the session.
This is important. Watch this space. If you have ongoing dollar weakness with softness in U.S. equities, it is a trend that could make some of the international portfolio managers reconsider how much of a hedge it is to buy U.S. assets in dollars, given the fact that usually the dollar rallies on any kind of weakness.
Should we finish on crude? I think it's important
Please.
to. Let's get that board back up. WTI, as of yesterday at the close, down for 8 consecutive weeks. We might avoid that today, but if we make it 8, that's the longest streak going back to 2015. Now, this is where the inflation story gets complicated for me. Can you build a case for persistent inflation, higher inflation, with crude down as much as it is over the last few months?
This is part of the design of the White House. They want to bring crude prices down. Saudi Arabia seems to be participating on the margins. There are a couple of other OPEC plus producers doing the same. You also have potentially weakening demand, but it raises this question. How secular can inflation be if you don't have a participation from going to the pump and filling up your car for a lot more money? And that, I think, is what a lot of people are trying to grapple with. Is there enough of this tariff-related inflation to get some sort of reinflation? Like, I don't know that there's a conclusion to that.
Crude getting a bounce this morning. We're up 0.9% on Brent crude. On our radar this morning, Senate Democratic leader Chuck Schumer saying he'll vote for a GOP spending bill to keep the government open. Schumer calling the bill, quote, very bad, but saying a shutdown would be much worse for the country.
The Democrats are struggling here. I would say Americans in general are not as interested in political shenanigans and who blinks and who doesn't than a functioning government, especially at a time where there is potential weakness. That's the reason why there are a number of moderate Democrats that want to push this through and then save the fight for something more significant later on. At the same time, you have to imagine the Democrats aren't coming together with any kind of cohesive message to counteract what they see as some of the problems with President Trump. And they haven't explained what they agree with as well as what they don't. And there are some policies that are actually pretty popular.
I think for the markets right now, don't care about the politics, they care about the policy.
Correct.
And we said this yesterday, the more we were talking about government shutdown, the less we were talking about tax cuts. Now you've parked that. Can you get optimistic that we can get this bill through Congress pretty quickly before year end?
If we do, and this I think is really a key consideration, especially for the bond market, what happens to 10-year yields? Because this will expand the deficit. The offsets that they're talking about with some of these job cuts, especially the ones that are being sort of questioned in the court system, are, not really compensating for some of the tax cuts that they plan later on.
The Treasury trade's got a little bit more difficult over the last week, that's for sure. Yields this morning up by 2 basis points, around about 430 on 10s. Elsewhere, a San Francisco federal judge ordering the Trump administration to rehire thousands of government workers who were terminated back in February, saying the Office of Personnel Management's order to fire probationary employees was illegal.
This is fascinating to me on two fronts. First of all, what actually gets through with DOJ? How do you do this, where you call someone up and say you just got laid off, but come back to the office because now the court system says you are back in the office, but the president is appealing this ruling, so you might be back out. I mean, how do you operate a business that way? On a broader level, it steps up a real fight, and Donald Trump's administration has appealed some of these state, local rulings to say, why should one judge in one region set policy for the entire government of the federal United States of America? And that is potentially going to go to the Supreme Court. Watch this space. That is going to be an interesting play.
I keep returning to the same point we've made over the past several weeks or so. If you're a federal worker right now, you must be so anxious about your job and what's going to happen. And maybe you can make the case, and we've said this before, that that's just the same anxiety that anyone in the private sector faces every other week. That might be true. But it does have economic consequences. Economic consequences we might not have thought about for a long time regarding federal employees. What are they going to do with regards to spending? Are they going to get that flight? Will they book that vacation? Will they buy that big ticket item? Will that show up in the data sometime soon?
It's not just federal employees. It's also all of the contractors, major corporations that get funding from the government. And you could say, well, it should be more in the private sector, but the speed at which it's being done is going to have ripple effects that cannot be offset in the near term as quickly. That is the reason why people are talking about potential thousands of layoffs in the near term, even without some sort of deep downturn in the economy.
We mentioned BMW a little bit earlier this morning. Let's get up to speed on what's happening over there. The company delivering a disappointing profit outlook for the year ahead, citing weak China sales and the potential impact of tariffs. The automaker expecting to take a $1 billion hit from escalating trade tensions between the United States and Europe.
What's amazing is they're in the middle and they're getting hit by all sides. They're getting hit by the EU tariffs on China, by BYD and the competition in China, and then U.S. tariffs on European goods. And they're in the middle of it all and getting buffeted. How do they get a competitive edge? What's their edge right now? How do they make an argument? To whom? Are they making it to the EU? Are they making it to the United States? They're making it to China? They're in a tough spot, and it highlights how people are very optimistic about Europe, but they still are kind of between the U.S. and China, and they're not in a great spot there.
It's a perfect storm for them and for the retailers too. Let's talk about the retailers. A growing list of retailers raising concerns. Target, Best Buy, Dollar General, Macy's, all warning they may have to hike prices due to the impact of tariffs. Oliver Chen of TD Cowen writing, increases in the prices of raw materials, rent, freight, labour tariffs, or manufacturers' inability to produce goods on time or to specifications may negatively impact results. Oliver joins us now for more. Oliver, welcome to the programme, sir. It's good to catch up with you. It's been a tough run for some of these retailers. Clearly, they're not sure of what kind of guidance to put out at the moment. Could you tell us from your perspective the kind of companies that you think will be in a difficult spot in the year to come?
Yeah, John and Lisa, pleasure to be here. So discretionary companies will continue to be challenged. The consumer right now is in a tough spot. The consumer is being highly considered, skipping trips. And as you've seen and mentioned, consumer confidence has been very volatile. So as we look at mall-based retailers, department stores, Target, that's been tougher. And guidance has been weak to flat to slightly negative. On the other hand, in terms of thinking about the positive and the good opportunities that we see, we like the defensive characteristics of Walmart, Costco, and BJ's, in part because these retailers have a lot of scale and are focused on value. That will continue to be a key theme as consumers are really feeling the pinch, especially with dairy and eggs. It's something to watch.
As the leadership committees get together, Oliver, and talk about offsets, what's available to them on their dashboard? Can they put pressure on the exporters to drop prices? Do they have to take it on margin? Can they pass it on to the consumer? Do they have to lay off employees? What are the options available?
John, it's going to be very tough to pass this to consumers because the consumer is highly elastic in terms of looking for alternatives and under pressure right now. What some retailers are doing are stocking up on more inventory today to the extent that they can. Certainly negotiating with suppliers has been an ongoing effort, and Walmart's been a very good player here in terms of scale. And then thirdly, the retailers are looking at where they can source with more diversification. The good part about this is retail's been through so many supply chain shocks. So there's experience with volatility, and also retailers have been on a journey to diversify sourcing. In terms of stocks, Costco is best positioned. About 20% of its goods are imported. And then Target, on the other hand, is more exposed, given more discretionary at 50%. And Walmart's well positioned at 30% too. But the bottom line is, bigger is better in terms of scale. Again, Walmart and Costco. And also those retailers which are fixated on offering consumers value, those are going to be retailers that consumers will flock to because this will impact the whole industry.
Bigger is better in general. We've been talking about that. And yet the story over the past couple of weeks about Walmart got our attention, where on one hand, they said to Chinese producers, OK, just lower your prices and we can just pass along the tariff costs to you. And China turned around and said, no, don't think so. So at what point will these companies get caught in the crosshairs of the trade tensions between the U.S. and China, as well as the U.S. and Europe and anything else?
Yeah, Lisa, I think it's unavoidable. I think everybody is caught here. And the issue is it's going to be very hard to pass these increases to consumers. So both Walmart will likely have to take a margin cut and negotiate with people along the supply chain, and consumers will also have to feel the pinch too. So it's very dynamic in terms of what retailers are trying to do, but everyone's trying to be best prepared as possible. That being said, Walmart has a long history of negotiating very tightly with their suppliers, and it's also done a very good job with rollbacks, meaning taking prices lower and having them stay lower. So this company really understands the cost structure, and the whole mission of SAM for many, many years and decades is this everyday low price model. So the company knows what they're doing with sourcing, and it's not surprising that they're trying to negotiate in a very aggressive manner.
Meanwhile, amid all the uncertainty this week, I think for all of us, we really paid attention to the airlines, and Delta in particular coming out and saying that they saw a huge fall off in consumer demand starting in mid-February. When you read the tea leaves and hear the commentary from executives at the retailers that you cover, has there been a similar trend, just a downward shift that's pretty notable?
Yeah, Lisa, what's happened at department stores such as Macy's, January has been tough with weather, plus headlines, plus consumer confidence, plus media. As you know, we're talking constantly about change, and the consumer is feeling on edge, and that doesn't lead to a good feel-good factor, which really translates negatively to spending, and especially spending that you don't really need to do. We do need to buy food and eggs, but you don't really need a new dress or a coat. And the consumer is choosing to delay when they can. So this is having a near-term impact, and it's worse than before. It's something we're watching because confidence has been volatile. The consumer does have money. It's been a lot about are they choosing to spend and where are they choosing to save? And certain places, they are choosing to trade up and splurge. So it's not when it is about winners and losers in this market of retail as well. Bottom line, department stores have had a tough time. Mall-based retailers have had a tougher time. Those retailers would need plus want, meaning food plus consumer discretionary, meaning a TV and other luxury items, as well as great priced chicken, such as Costco. Those are working best.
Let's talk about some of those losers. Let's finish on that. Kering, down today by about 10.5% as they tap Balenciaga to go over to Gucci. Oliver, how is that going to work, and why is the stock getting hammered just as much as it is?
John, I know you know a lot about Gucci, and Lisa brought up some great comments earlier. We hosted them yesterday, and think people were expecting a bigger name, perhaps from the outside of the organization, but Demna comes from Balenciaga, and he has a very good background, actually, in cutting suits and tailoring from Margiela as well as Louis Vuitton in Antwerp. So we're looking forward to that. The other thing is they know a lot about Demna from Balenciaga. It's a good thing because any of these creative changes can add risk. And the bottom line, Gucci needs more sparkle, it needs more drama, and Balenciaga's done a good job with theater in terms of bringing a lot of interesting attention and cultural relevance to that brand. The Gucci strategy is going to continue to be very elevated and organized and thinking about balancing quiet and loud luxury. They need a designer with more pizzazz, more sparkle. This is one opportunity, but the market was expecting a bigger name and perhaps an outsider.
Oliver Chen of TD. Oliver, appreciate it. The view on Kering there. Kering at the moment negative by 10.3% in early trading. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. How's this for some sparkle? Gold rose to a record high, topping $3,000 an ounce. It comes as President Trump's tariff agenda and his latest escalation fans concerns about U.S. economic growth. The precious metal extending its gains from last year, supported by central bank buying, as well as inflows into ETFs. The UAE's national security advisor is planning to visit Washington to press for easier access to American technology and discuss investing in the U.S. Bloomberg has learned that the meeting could take place as soon as next week. The UAE wants the ability to buy cutting-edge chips from the likes of NVIDIA. And an American Airlines Boeing plane caught fire at the Denver International Airport. The plane made an emergency landing due to engine vibrations, then caught fire while taxiing to the gate. 172 passengers and 6 crew members were safely evacuated, while 10 people suffered minor injuries. That's your Bloomberg Brief. John?
Hey, Yahara, appreciate it. Thank you. More from Yahara a little bit later in the programme. It's the people who go to their phones almost immediately when these things happen. I'd be sprinting. I'd be long gone. Yeah, but you get your phone out and you start recording it.
But thank you for it, because now we can talk about it and analyze it. I mean, the fact, though, that they do that highlights just how many there have been and how there's a protocol for it. Film it, put it on the social media, and everybody gets scared.
And not a good week for the airlines, that's for sure. Up next on the programme, President Trump is not ready to bend.
Any chances that you will ban on the tariffs on the aluminum and the ones that are planned for April 2nd?
No, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all.
Ed Yardeni is of Yardeni Research. He's changed his price target on the S&P 500. He joins us next. We are bouncing back this morning by 0.8% on the S&P 500, by 1 full percentage point on the Nasdaq 100. On the S&P, on the week so far, before today's move, we're down by more than 4 full percentage points. And the President Trump, is not ready to bend.
Any chances that you will ban on the tariffs on the aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your mind?
No, I'm not. Look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years.
So here's the latest this morning. President Trump standing firm behind his tariff agenda, reiterating plans to keep steel and aluminum tariffs in place and move forward with fresh tariffs on April 2nd. Ed Yardeni of Yardeni Research citing Trump as he cuts his year-end S&P target to 6,400 from 7K, writing, quote, "We can't ignore the potential stagflationary impact of the policies that Trump 2.0 is currently implementing." Ed joins us now for more. Ed, welcome to the programme, sir. An important distinction here. Your revision is off the back of a change to the multiple and not to earnings. Can we start there? Just explain the difference between the two.
Well, look, it's PE times E when we try to think about where the market's going. And I'm still hanging on to the idea that the economy is resilient. Over the past 3 years, we've had a tightening of monetary policy. And despite the tightening of monetary policy, the economy has continued to grow. So I'm hoping that experience demonstrates that the economy will be able to withstand this mix of stagflationary policies. On the one hand, we've got a policy that's increasing the tariffs, which could potentially slow the economy down. And then, of course, we've got the Doge boys cutting back payrolls pretty aggressively in the federal government. Yet, despite all that, initial unemployment claims remain remarkably low. And there's lots of articles about how the consumer is going to retrench. But I think we're actually going to find that once we get March and April data, in the spring there will be growth, as Chauncey Gardner once said. Remember Chauncey? The idea is that the consumer will prove resilient. There was a lot of weakness in the consumer in January and February because both months were actually colder than average. And so I'm expecting that the economy will actually hang in there.
So how much is this revision downward to your S&P call by year end a bond market call and not really a stock market call, with the expectation that bond yields will remain higher in the face of inflationary pressures?
Yeah. Well, we've been expecting that the bond yield would stay high. We think that bond yields are kind of normal. They're back to basically 4.5% plus minus 25 basis points is kind of where we think bond yields should be. And as we've all noted, notwithstanding some of the weak numbers that we've had of late, the bond yield has actually gone up. No, it's basically a call on the fact that valuation multiples have been high historically, and they've been high historically justifiably if the economy continues to grow and giving us plenty of opportunities for earnings to kind of fill in for valuation multiples. But clearly, there's at least a recession scare. Lots of people are talking about a recession. As a matter of fact, last week, we raised the odds of a recession from 25% to 35%. So we're not saying that there's no way the economy is going to slow in the face of what's going on, but we're still betting on the resilience of the economy and earnings, but we think valuation multiples have already come in and will stay lower than we thought.
Just a couple of weeks ago, Ed, you were sticking with the 7,000 target on the S&P for the
Yes.
year end. And you did make this revision just now of moving it down to 6,400, which is still a 16% upside from where we closed yesterday.
Yeah.
What triggered that? What made you think, okay, we need to take action because what's going on gives us a sense that maybe this isn't going to pass so quickly?
Well, that's a good point. I think we are going to get some tariffs, obviously, but I think there are going to be negotiations. Maybe in some areas, as you just showed, the president's going to be stubborn on aluminum and steel. But I think there's room for negotiations on tariffs in lots of other areas. So that's what I'm expecting. The April 2nd is going to be kind of important because that's when we're going to have the reciprocal tariffs across the board. And I think that obviously will potentially could trigger more downside in the market in the short term. But I think it'll also trigger a lot of negotiations to reciprocally bring those tariffs down.
Hey, Ed, it's a thoughtful call, and we appreciate your time breaking it down this morning. Ed Yardeni there of Yardeni Research on the latest for US equities. A lot of people come on the programme. I've heard this a lot out there as well from people talking about the Trump agenda. He said all this on the campaign. Why are people so surprised? The surprise is actually coming from elsewhere. It's how others have responded to the tariffs, how others have responded to the policy shift in the White House. And by others, I'm talking about the Europeans. This headline just crossing, some reporting coming out of Germany that German parties have reached an agreement with the Greens on the debt package. That's pushing bond yields up in Germany today. That's pushing bond yields up in France today. Levels we haven't seen in more than a decade.
Yeah, since 2011, you're seeing French 30-year bond yields rise to 4.17%. Talk about pressuring yields higher around the world. And the fact that Germany actually looks like they are going to get this through highlights how quickly and how unusual it is for the example of fiscal austerity be coming out with a fiscal package that could amount to almost 1 trillion euros.
The German 10-year up by 8 basis points and getting closer and closer to 3%. The 10-year Bund, 2.93. Coming up next on the programme, Barbara Doran of BD8 Capital Partners, Maya McGuineas of the Committee for a Responsible Federal Budget, and the NATO Secretary General, Mark Rutte. Look out for that and more in the next hour.
hard to bet against the U.S. consumer right now, even though uncertainty is higher.
While there's a lot of well-deserved attention on tariffs, let's not lose sight of the consumer whose spending has slowed.
The tariff policy on again, off again is impacting the sentiment of consumers.
We've just seen confidence continue to deteriorate.
What consumers are doing is essentially hoarding ahead of any potential price increases.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 unlocking some gains, up by 0.8% on the S&P. On the Nasdaq 100, we look a little something like this. Equity futures pushing higher by 1 full percentage point. On the week, though, still down on the week and heading towards a fourth consecutive weekly loss on the S&P 500, a stretch we have not seen since August. The good news, and this is good news, we're set to avoid a government shutdown in Washington, D.C. The bad news, over the next few weeks, we'll still be talking about the same thing, and that's tariffs down in Washington and what it means for the economy, for the labour market, and for consumer sentiment as well. Later on this morning at 10 a.m. Eastern Time, look out for this. Mitch, consumer sentiment. How important is that data point going into the FOMC next week?
Stuart Kaiser of Citigroup said that it was oddly important at a time where a lot of people used to discount it as incredibly political and noisy and not very reliable given the small sample size. Nonetheless, any kind of real-time data showing how quickly sentiment is shifting and how much consumers are shifting their behavior is really important at a time where the airlines have come out and told us things are changing very quickly and demand has been falling pretty dramatically.
Delta Airlines down for 6 consecutive sessions, a run that has built losses to more than 20%. That is a massive amount of market cap that's come off Delta Airlines because they're saying the quiet bit out loud. It's not that we think this is going to happen. It's not speculating or guessing. In the middle of February, consumers and business activity started to stall. That's been weighing on that stock all week.
And the reason why it has been having a wider implication is because we're hearing the same message from Southwest, from JetBlue, from United, from American. This is not necessarily just a Delta issue. This is government workers. It's hard to take a step back. But one thing that Sheila Kahyaoglu said was, we're still coming off a pretty hefty pace of gains and travel. So how much is this a normalization versus something else? But Oliver Chen talking about the consumer sector and the retail space and how it, too, is seeing a similar kind of trend.
That stock is bouncing this morning by 1 full percentage point. That's the story stateside. We need to talk about Europe. Germany slowly coming together for an agreement to pass a spending plan. And in Germany right now, bond yields are higher by 7 basis points. We're getting closer and closer to the line in the sand that is 3% on a German 10-year yield. Lisa, we're at 292 this morning.
Yeah, it's the highest level going back to late 2023. How much higher can it get if they do end up borrowing at least almost $1 trillion more euros just for infrastructure and a baseline defense spending package, but really opening up the deficit spending potentially as a blank check to support some sort of outgrowth of their military. Real questions here about how much structurally has shifted and how much they can change some of the trajectory of growth on the heels of military spending, as well as infrastructure spending that could take a decade. It's a very difficult calculus right now.
I was listening to the ECB President Christine Lagarde conducting an interview over in Europe earlier on today, and she was asked about the tariffs. Won't that hurt Europe too? Doesn't that mean the economy falls into recession? And she pushed back and she said, I think this will energize Europe, and you're seeing that. It's the policy response to this that is pushing equities up, bonds down, and yields higher across the continent.
And she says that for growth around the world and for prices around the world, but particularly in the United States, will there be that pain felt? So increasingly, it's the opposite of what people expected last year, that trade wars would hurt Europe, would hurt the rest of the world. Now they're turning the tables back to the United States.
Do you want some pushback?
Yes, please.
Comes from Bank of America.
Yes.
Not bullish on European equities. Markets have shifted towards a slowdown. That has further to go. EU equities still priced for global PMIs to rise. They don't think they will. That's the pushback. It's still out there.
And the pushback is also coming from BMW. The fact that you're seeing that the main industry in Germany is getting buffeted by crosswinds from both the United States as well as China with respect to tariffs on both sides. Europe still faces a long road ahead of it. And a lot of the bulls in the United States for risk assets are confident that there will be a policy response either from the Federal Reserve or from President Trump. And that is giving them confidence to not really buy the Europe train just yet.
Just to recap that European story for you, this is according to a report coming from the German news newspaper Handelsblatt that the Chancellor-in-waiting Friedrich Merz has reached an agreement with the Greens Party on a fiscal reform package for the investments into infrastructure and defence spending that we've been talking about now for a number of weeks. Here stateside, equities are recovering on the S&P 500, higher by something like 0.75%. Coming up on the programme, we'll catch up with Barbara Doran of BD8 Capital Partners after stocks fall into a correction. McGuineas of the Committee for a Responsible Federal Budget and the NATO Secretary General Mark Rutte on the push for peace in Ukraine. He joins us at 7:30 Eastern Time. We begin this hour with stocks higher. The S&P looking to recover after sliding into the first 10% correction in almost 2 years. Barbara Doran of BD8 Capital Partners urging patience. A pullback is normal and not unexpected. Market is trying to discount the worst case given uncertainties, but finding stability is elusive until policy stabilizes. Barbara joins us now for more. Barbara, good morning and welcome to the programme.
Good morning. Delighted to be here.
Are you expecting that policy stability anytime soon?
Well, the question is, what is soon? I mean, I think is sometime in the next month or two, yes. I mean, things that right now it's beginning to feel like the boy who cried wolf. Although there is real substance and President Trump is determined, to have some sort of parity on the tariffs. But I think we are going to begin to have clarity. I think there's a lot of concern in the administration in terms of they're getting pushback from their constituents, and all the uncertainty is starting to show up in the numbers. You had mentioned earlier about consumer confidence surveys. Two of the most important a few weeks ago showed suddenly short-term inflation expectations have zoomed up. You're seeing a holdback in company managements. Things on hold. How can you decide on capital commitments or hiring until you really know what the impact of tariffs are going to be? You saw Bank of America and Citi this week in credit card debit spending. It's down in February versus, robust December and January. So what I think you're seeing people on pause, both consumers and managements. That, I think, is temporary. Balance sheets are strong, both corporations and the retail and the individual investor. But, if it continues a lot longer, and I think there's, a lot of the advisors around President Trump are very concerned with that. And so I think, right now, also, it's so out of the blue, seemingly some of these things like yesterday, 200%, on champagne from France.
Why not?
I'm glad I had some champagne, recently. It's probably it for a while.
I hope you stocked up.
But anyway, and I think those kinds of things are going to calm down, because I think our allies, especially, it's, how do they respond? And I think they're figuring out how they respond.
How do you respond as an investor? Let's talk about the damage done to stocks. So on a headline index on the S&P 500, 10% correction. Beneath the index, we've done loads of damage to some of the biggest tech names on the planet. 20% moves. How are you thinking about allocating capital into this downturn?
Well, I own, almost all these large mega cap. And, what you mentioned about canceling patience, we've sold this a lot last year. The market's been up 24+% S&P 500 the last 2 years. And what you saw last year was a continual rotation. And where does the money come out of? It comes out of the high performers. And that's the momentum big cap names. And so I think that's what you've seen here. I mean, they were all been killed. You saw NVIDIA, down from like 150 just a few weeks ago to 106, earlier this week or late last week. And now it's bounced up. And so you've had a lot of corrections in these names. Amazon, Meta, these have sustainable, visible growth for some time. So money will rotate, and there's been cherry picking down here. So I think, what you'll probably see in here, the market's trying to find a bottom. There will be a bounce. Some people will sell into it, but I think otherwise you wait, things will recover. We're going to have more visibility, I think, in the next few months. The Republicans in Congress are working feverishly, on tax cuts and deregulation so that we can get the trade tariffs out of the way, because that is really taking all the oxygen out of the air.
So where do you wait? And I say this as I see a number of portfolio constructions like stagflationary protection basket from Goldman Sachs or all-weather stocks from Evercore ISI. How do you identify the places that are more immune to some of these shocks at a time where the high beta stocks are going to continue to be a proxy almost for some of the sentiment?
Right. Well, so much it depends on the type of investor you are. For my clients, I'm a long-term investor. It is stock picking in names that we're going to have this volatility. Stocks are volatile. And those kinds of things, you saw a big rotation immediately into the staples, into utilities. That's where people go to hide. You have cash. We're still getting high yields on even money markets, depending where you are, 4.5%. So if you are the type of investor or a management, you rotate into these names and wait. But, they're already expensive. So unless you reacted, like that, I think you just have to be patient in your portfolio and cherry pick,
What I'm trying to figure out at this point is how much the bullish thesis on U.S. equities and the U.S. economy is predicated on the idea that someone has to blink first, either the Fed or President Trump. And there has to be some sort of policy response one way or another. And whichever it is, it will be supportive for equity markets down the line. But that ultimately is the white hope right now behind a lot of the ongoing optimism in equities.
Yeah, no, I think that's exactly right. And I think the Fed, right now is probably focused a little bit more on growth than inflation. I mean, you saw the PPI, CPI numbers. Things were better than expected in some regards, but underlying price pressures in the PPI, which of course we're all looking to see where is it starting. Part of that might be explained by inventory build. People are rushing to bring in inventory before whatever tariffs go into effect, and they don't know. So I think that the Fed is right now no probability that they will cut any in the next month or two or next meeting or two. Because I think they're watching growth. And I think if growth does really, it's more than just this sort of stutter step. I think the Fed will start to think about cutting, even with, inflation. Because inflation, I don't see it popping up. There's going to be pressures. It's not going to be like post-COVID, So I think it may be stalled out here, but that's okay. It's really switching more to growth worries, which we didn't have a month ago.
We've seen certain central bankers tackle some of these policy issues head on. The Bank of Canada, Lisa, was talking about that earlier this week. The ECB President, Christine Lagarde, is talking about it openly. Do you expect the same approach from Chairman Powell on Wednesday, March 19th?
No. I think Chairman Powell has bent over backwards to be apolitical, not even to touch when he gets questions from reporters about any kind of policy. He says we are waiting and watching because they know this does have an impact. And so they're not going to opine. They want to make sure they keep their reputation for independence. And whatever, the administration does, they will react and incorporate it into their predictions. But no, I don't see him coming out and, beating the drum on anything in terms of policy.
I'm not trying to sell it because we're covering, but it's going to be a high-pressure meeting next Wednesday. High-pressure news conference for Chairman Powell.
Especially because he has alluded to policy shifts, and he has talked about the different pressures on the Federal Reserve. And on one hand, you could say it's politically tenuous for him to talk about it. On the other hand, you could say he's waiting for what? What's the key moment that he's waiting for? Well, he'll get a sense of what policies are that have already been enacted and that already have been laid out.
That two-day meeting starts on Tuesday, concludes on Wednesday next week. Barbara, good to see you. Thanks for dropping by.
Thank you.
Thank you. Thank you very much. Barbara Doran there of BDA Capital Partners. Just to update you on the latest out of Germany, Friedrich Merz, the Chancellor-in-waiting over in Germany, said to have reached an agreement with the Greens on a fiscal package, a very important development over in Europe. Yields are higher by 6 basis points on a German 10-year to 91. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Ukraine attacked Moscow with drones for the second time in a week, with at least one hitting a central area near government buildings. Russian air defenses intercepted 4 drones, and emergency services worked at sites where debris fell, while Ukraine hasn't commented on the attack. Meanwhile, Bank of America's Michael Hartnett says that the slump in U.S. stocks is a technical correction rather than the beginning of a new bear market. Hartnett says a further downturn would prompt policy intervention and recommends buying the S&P 500 at 5,300 points, a level that he says, including other factors, would indicate the sell-off is over. And a San Francisco federal judge has ordered the Trump administration to rehire thousands of the government's newest employees who were terminated back in February. The court found the Office of Personnel Management's order to fire probationary employees was illegal. The administration says it will appeal the ruling. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, Democrats blink.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So in just a few minutes, we'll catch up with Annmarie down in Washington, D.C., and we'll speak to McGuineas of the Committee for a Responsible Budget from New York City. This is Bloomberg. Let's head straight to Germany. Bonds are down, yields are up. by 5 or 6 basis points, getting closer and closer to 3% on a German 10-year yield, 291. This is the latest from the team reporting out of the continent. The German Conservative leader, Friedrich Merz, the so-called Chancellor in waiting, reaching a tentative agreement with the Green Party on a debt-funded spending package for both infrastructure and for defence. Of course, the deal needs to be approved by party lawmakers, and from what we understand, the Democratic-led bloc, the Social Democrats and the Greens have called a meeting with their lawmakers for 1 p.m. local time, which I believe at the moment is 8 a.m. Eastern time, so about 45 minutes from now.
And we'll get a better sense of how quickly they can get this through and any of the details. I just wonder how much this is a Germany story versus something that will trickle out to the rest of the Euro region, given the fact that there are debt limits that are constructed for other countries. Can they get out from under it the same way that maybe Germany has?
I would say it's a global bond market story. That's for sure. Let's turn to equities. Equity futures just off session highs by 0.7% on the S&P 500. A positive development in Washington, D.C. Under surveillance this morning, Democrats blink.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So here's the latest this morning. The Senate Democratic leader Chuck Schumer opting for the path of least resistance, avoiding a disruptive government shutdown. Republicans now set to push forward with other aspects of Trump's agenda, including tax cuts. Annmarie joins us now from Washington for more. Annmarie, from the market perspective, a rare piece of good news.
It is a little piece of good news, of course, Jonathan, when it comes to making sure that the government continues to function. Even if this were to go through, it would have been a short shutdown. But you have to see how quickly the Democrats folded. Just 48 hours ago, Chuck Schumer, the Senate minority leader, was talking about how the Republicans don't have the votes. Well, they do have the votes. And now it's a green light for Republicans to work out enacting Trump's full agenda. And for that conversation and what the extension of TCJA might mean for our deficit, I'm very excited to bring in Maya McGuineas. She's, of course, with the Committee for a Responsible Budget. Maya, thank you so much for joining us. Let's talk about the future now. How much spending are you seeing potentially added to the deficit when it comes to the extension of TCJA and also some of the other tax proposals the president talked about on the campaign trail?
Well, the potential price tag of this whole deal just keeps growing and growing. So the current plan, the tax bill as they're talking about it right now, would cut taxes by about $4.5 trillion. But it looks like there are a number of new tax policies, new tax cuts that they would like to add, many of those from the president's promises while he was on the campaign. It would also have about $300 billion in new spending. All of that is offset by $1.5 or $2 trillion, leaving a gap of $2.8 trillion. Does it make sense for us to borrow more right now when we're at near record debt levels and we're about to add $22 trillion to the deficits over the next decade? Obviously not. They really need to find more spending offsets. I would put in context, the $2 trillion they're saving is out of a full $86 trillion in spending over the same time period. But there's lots of discussion about how this is too much. I'm very concerned that'll get watered down in the Senate and the tax bill will get built up. So as much as this is looking like it will be a tax policy bill, it's going to be a deficit busting bill at a time when clearly that's not the direction fiscal policy should be moving.
Well, there also might be a way to almost trick the accounting. The Wall Street Journal editorial board is out with a piece today, and they say using the current policy baseline to extend current tax law is in the best interest of the country to avoid a giant tax increase, and Republicans can rightly defend it. Failing to do so will make Republicans prisoners of phony Washington accounting. Do you think they're going to go from current policy or current law? And tell us, Maya, for our audience that doesn't really know the ins and outs, what's the difference?
Yeah, isn't budget accounting fun? Yes, they probably are going to make the change, and it's an absolute gimmick that everybody who's doing it and every paper that's editorializing in favor of it knows is a gimmick that just makes tax cuts easier. So when they passed the tax cuts in 2017, some of those taxes were permanent, like the corporate rate reduction. Some of them expired. The reason they expired was to make the price tag look cheaper so it could remain within the limits of reconciliation. Now that they're extending it, they're saying, oh, we shouldn't have to acknowledge those costs because the policies are already there. But they didn't acknowledge the costs in the beginning. They're not acknowledging them now. So it's a way to kind of magically wipe away $4 or $5 trillion. But you know who that's not going to trick? It's not going to trick bond markets. They are still going to have to absorb the additional $4 or $5 trillion in treasuries over the coming decade. The argument that the Journal and others have made is, well, spending is treated that way where you assume it's permanent, even if it's a temporary policy. But the difference is if you do that on the spending side of the budget, you have to acknowledge those prices up front. The CBO assumes them in their projections. When you look at the debt numbers going forward, it assumes a permanency on the spending side. If the taxes, they say they're temporary, they take them at their word. Should they equalize them? Sure. But what you can't do is pretend that expense never happens, which is what the Senate is about to try to do. And they're going to try to drag the House along with them. And it's another gimmick because guess what? Lawmakers are unwilling to acknowledge they like tax cuts, but they're not willing to have the spending cuts that would bring them down so that they wouldn't actually blow a hole in the national debt. And that, again, it's not good. That's what they're about to do. Yeah.
It's a good point. You could do this on a legal pad, but the bond market will actually view this as more spending, and potentially we could see a bond market reaction. Do you think the bond market will be the ultimate check, maybe on this spending package, on this tax extension bill?
You know, it's a great question because the bond market is a place where we will see concern, but it also depends. The markets also love tax cuts. So they're going to be of two minds. Markets are concerned about borrowing and really want tax cuts. And a lot of times when it comes to the economy, I think people sort of hope and believe for what they're wishing for. I think the best warning signal is this Congressional Budget Office. Anybody who wonders where we are in fiscal policy should just look at the charts they put out. We put out charts as well. It is undeniably unsustainable when your debt is growing faster than your economy. Your single fastest growing part of your budget is interest payments. Even if the debt is going to grow from policies that you like, in this case, tax cuts, it doesn't mean that that debt is going to be a good thing for the economy. And when you hear people making claims of, don't worry, we'll grow our way out of this, those claims are assuming growth rates that are 3 times higher than the other highest estimates out there. Massively inflated growth rates to allow lawmakers to say this won't add to the debt. It will, and markets should not be reassured by that claim because we're going to see these net debt numbers continue to grow.
Maya, when it comes to spending cuts, how much could be offset between what is going on with this administration when it comes to DOGE and that effect?
Okay, so DOGE is a completely different effort when it comes to actually making a big difference in the fiscal situation so far. I look at DOGE as a great idea of going through line by line, really understanding what's going on in the government, figuring out where the waste is, figuring out where you could do things more efficiently. I think there's a huge error that DOGE seems to be taking action first and evaluating second, and we should clearly switch those things. There should be the deep evaluation they're doing before we make any changes. But so far, the numbers that they're coming up with are in the billions of dollars. We're talking about needs for savings of trillions of dollars. So I think we should think about DOGE as really improving the systems. Let's look at where there's systems like healthcare delivery or defense procurement. There's so much waste. See what savings can be generated. I'm really interested to see how they can use technology to improve those systems. But again, I think the efforts to dismantle government before the fix is there and to make mistakes by going so quickly, that actually increases inefficiencies. Either way, we're not talking about numbers that are close to the magnitude of what we need to be talking about. And what we need to be talking about is what no politician will talk about, which is we need to fix Social Security. We need to fix Medicare. We need to raise taxes before we cut taxes. We need a big debt deal instead of continuing to do things that make the situation worse.
Maya, thanks so much for your time this morning. Of course, it's Maya McGuineas, Committee for Responsible Federal Budget. Jonathan, key point there is if they want to keep spending, the bond market might push back.
Annmarie, appreciate it. More from Annmarie coming up in just a moment. She's going to be catching up with the NATO Secretary General Mark Rutte on the push for peace in Ukraine, and as Germany and German lawmakers come together to try and push forward a spending package on defence. That conversation up next. Equity futures near session highs, up by 0.75% on the S&P 500. The damage done so far, you are familiar with it. We're down by more than 4 percentage points on the week so far and heading towards a fourth consecutive week of losses. At the moment on the Nasdaq 100, up by 1 full percentage point, and the Russell of small caps up by 0.9. Elsewhere, let's talk about policy and politics. G7 foreign ministers meeting in Canada. Top of their agenda, ongoing support for Ukraine. On the ground, Bloomberg's David Gura. David, welcome to the programme. How contentious will this get-together be?
You know, it's interesting. We hear that there's kind of two different summits taking place, and the one that's taking place inside the meeting rooms is actually kind of peaceable. All of these high-level delegates are talking with one another and ticking through a lot of these issues on the official agenda. But this is a summit of two dueling agendas. There's the official one, as you say, which is so focused on Ukraine and the path forward there. And then there's the other one, which is the unofficial one, and that is how trade is reshaping the global economy, all of the tariffs that have been put in place, and how more broadly than that, kind of the geopolitical foundations have shifted here over these last few weeks. Yesterday, I spoke with the EU's chief diplomat, Kaja Kallas, and she talked about a very signal moment that took place yesterday morning. There was a conversation about Ukraine, and then word leaked out about that conversation that had been taking place in Saudi Arabia over the weekend, and how Steve Witkoff was on his way to Moscow. Everyone looked at their phones, they broke for a few minutes, and then there was kind of the expectation that the Secretary of State, Marco Rubio, would come back and brief the group there on what had happened. She said that did happen. They have some indication of sort of how that meeting unfolded, but it is something that looms large over every conversation they're having here. All the while, these diplomats are looking at one another, sort of wondering what's happened to this ally that they've trusted for so long, what the path forward is for them when it comes to the economy, when it comes to geopolitics. And as Kaja Kallas told me, she's hearing good things from the Secretary of State, but of course, having looked at the past, looked at President Trump's first term, and now at this one, there's this open question of sort of whether what he's saying will be mirrored by what the president, his boss, has to say. And that's certainly the unknown that a lot of these diplomats are dealing with, John.
David Gura, appreciate the update. Thank you, sir. This is the appetizer. The main course is later this summer, June. Canada's the host country for the G7 this year. Leaders meeting in June. Just imagine what that's going to be like with President Donald Trump and some of the ideas that he's pushing regarding Canada.
Yeah. 51st state, maybe it'll be held in America by then. I mean, look, I'm being tongue-in-cheek here, but it really raises this question of how you have some sort of mending of the fences at a time where we have seen such fissures and such animosity, such personal animosity develop between these two neighbors.
Yeah, we were talking to the Commerce Secretary, Howard Lutnick, yesterday about turning down the temperature. I'm not sure that he did a good job of turning down the temperature in that conversation.
They should be grateful. They should say thank you.
They've only got 60 planes or something like that.
They can't defend.
It's going to be an interesting meeting in June, let's put it that way. Let's extend the conversation and head down to the nation's capital, where Annmarie is standing by with a special guest. Hey, Annmarie.
Hey, John. Well, the man that was turning down the temperature yesterday in the Oval Office was the new Secretary General of NATO, Mark Rutte. And we're so excited he's joining us today. His first interview following that meeting with President Trump. So this is your first trip to Washington as a Secretary General, sitting down in the Oval Office. How was your conversation with the president? We saw the 40 minutes or so that was out to the public, but then you guys had lunch. What did you take away from that meeting?
It was a very positive meeting. We became friends when he was Trump 45, and I was still Prime Minister of the Netherlands. So we worked very well together, and it was a very friendly lunch, and also an absolute clear commitment to the alliance, to NATO, to what the alliance stands for. So it was very optimistic and very positive.
So you took away that Trump is 100% committed to the alliance, even though individuals in his orbit, like Elon Musk, are calling for the U.S. to leave.
He was absolutely clear. There was no room for doubt there. And he did, by the way, state the same when he was meeting with Macron, the French president, and with Starmer, the British Prime Minister, 2 weeks before. So I tell some of my European colleagues when they say, well, is the US still connected and committed to NATO? I tell them you might want to turn on your television and listen to the president when he says this. Because he was on the record, and again yesterday, stating this. So I have no doubt, and there is no reason to doubt that.
Did you see Elon Musk yesterday? Were there any individuals at this table that you had to convince for the reasons why the U.S. should be a part of the alliance?
Well, Elon was not there, but in the conversation there was nobody there doubting the need for alliance. But, of course, everybody very much pushing for more spending, and particularly on the European side, because we are lagging behind, but luckily we are now ramping up, and we're spending much more on the European side of NATO. Look what is happening now in Germany. This is staggering, potentially €500 billion / dollars extra on defense spending. That's historic.
So the Germans have reached this morning reporting out of Germany on this debt package. As you say, there's going to be a lot more money coming out of Germany for defense.
It looked positive, I think. They had to deal with the Greens, but it seems that they're getting there.
Yeah, it seems like they're getting there, and there will be an agreement in place. There is a debate, though, when it comes to Europe, or whether or not Trump is helpful because of things like this. The Germans are finally starting to spend on things like defense, not having to outsource it to the United States. Or is Trump unhelpful because he really is shaking up the global order, not just when it comes to militarily, but also things like tariffs. Yesterday, 200% on European wine, champagne, and cheeses. How do you view his impact on the continent?
I think when it comes to defense spending, he is extremely helpful. And I told him yesterday, Trump 45, again, his first term. We had pledged in 2014 to go to the famous 2%. Nothing happened. He came in 16, 17. And then immediately you see the defense spending coming up. Now the aggregate amount is about 700 billion, going into 1 trillion extra. That was Trump 45. Now the second Trump presidency, he is only in his 50th days now, I think, or 51st day. We have seen 800 billion from the Europeans. We have seen this half-term package from the Germans, but also the Brits, the Swedes, the Czechs, the Belgians, so many others ramping up. And this is because they sense that with Trump in the White House, this is necessary, but also, of course, because we all realize in Europe and here in the US that Russia and China pose a threat. And that we have to rearm ourselves because they are doing this at an incredible pace.
But on trade, he definitely is ratcheting up the tension when it comes to trade policy, tariffs with the European Union. Does that send the wrong message to NATO adversaries?
Well, I would leave that to the EU and the US, but when I look at from an alliance point of perspective, I would argue that Europeans are buying 4 times more when it comes to defense industrial products here in the US than the US is spending in Europe. And I don't mind that difference, so that it is a 4-to-1. So you guys are getting much more, a better deal here than the Europeans. And that will only become more because if we keep the equation the same and spending more, you will have the overall amount being involved really getting up. And already it's a couple of 100 billions over the last couple of years. The F-35s, the Patriot systems, and all the other great products from the defense industrial base here in the US being bought by the Europeans. And that's good news.
I know you're preparing for the Hague summit this summer. Do you think you're going to increase defense spending to what the Trump administration is calling for, 5% of GDP for all NATO members?
Well, but what we are doing is we have a process in place where we exactly determine what are the gaps, and these gaps are big. So we have to do a lot more than we're doing now, so it will be considerably more than 2%. We first now, the next couple of weeks, will decide on exactly what the gaps are in terms of long-range missiles, in terms of our armies, which are depleted, in terms of our defense against ballistic missiles, our command and control systems, all that. That is the priority now, and then you will come to a new number. And that will be much more than 2%. I believe it will be more than 3%, but I cannot now totally envisage where it will end up. But when you look at the hundreds of billions pouring in now, basically it is already happening, and that's the good news.
Do you think that's an optimistic goal, or will that be a red line for this administration, say 5%?
I think what we need to do collectively is to make sure that we can defend ourselves. And at this moment, we cannot defend ourselves going forward. Yes, now, but not in 4 or 5 years, because the Russians, for example, ammunition are producing in 3 months what the whole of the alliance, including the US and up to and including Turkey, is producing in a year. So we have to ramp up defense industrial production, and we have to ramp up on the European side and the Canadian side the defense spending. And we will decide on that over the next couple of months. And it has to be content-based, but it will be much, much more. And again, when you look at the numbers coming in now, the Trump effect of this new Trump presidency is clearly there.
When it comes to defense of Europe, did you and the president talk about potentially amending where troops are, American troops, on the continent? Because there were reports that he was thinking maybe pulling out from Germany and putting more troops on the eastern flank, maybe to Hungary.
Well, we didn't go into that detail, but what we know, when Pete Hegseth, the Secretary of Defense, was visiting NATO, he was on the record saying, hey guys, you have to understand that as a United States, we also have to pivot towards the Indo-Pacific. So that means that we have to take care of more than one theater. Yes, the European theater, also the Middle East, also the Indo-Pacific. This, of course, history made you the leader as United States. That means that you have to attend these various issues. And that also will mean probably over time, the Europeans spending more, that you guys will have to look at, okay, where can we best deploy our troops? But that will be a gradual process, taking time and not abrupt.
There was definitely, with this administration coming in, more troops being put on the U.S. southern border. Under the Biden administration, though, there was a surge of about 20,000 troops to Europe. Is this administration going to pull back that Biden surge of 20,000 troops because they have other priorities, like the southern border, like the Red Sea in the Middle East, like the Asia Pacific?
Well, we didn't discuss those numbers in that detail.
But would that concern you?
No, what I think is important is that the US is committed to NATO, committed to the whole of the alliance, and is also committed to, if over time the Europeans are doing much and much more, and for the US also to attend to other issues, like in the Pacific, and by the way, as an alliance, as a collective of 32 countries, we can also be helpful in a sense of projecting more American power at the world stage, because the US not being on its own, but embedded in an organization with 31 other allies. Giving that
Do you think that was missing in the past 4 years? American power on the world stage?
I think it was there, but I think we could have done much more. And when it comes to the European side of NATO, we were still lacking behind in terms of our defense spending. And again, I
there's
think
a hot war in Europe right now, and that's what I want to talk to you about, what's going on in Russia
Absolutely.
and Ukraine. While you were in the Oval Office, Steve Witkoff, the president's longtime friend, his special advisor, second meeting he had with President Putin in Moscow. Coming out of that meeting, Dmitry Peskov is saying he's cautiously optimistic. When do you think we could see a 30-day ceasefire?
Well, I cannot predict that, but what I can say is that I'm
But
happy.
you're in more rooms than I am.
Yeah, I know, but let me say this. First of all, the Trump administration, the president himself, broke the deadlock on this war, because he started to engage with the Russians. I think that's positive. With the Ukrainians, that's positive. And there was a deal last Tuesday in Saudi Arabia between the US and Ukraine on pushing for the ceasefire. So this is all good. Obviously, the US administration is now dialoguing with the Russians to see where they are on this. And that will be a step-by-step approach. But this is literally developing over the next couple of hours and days. So very hard to predict when it will happen. But I think this idea of having a 30-day ceasefire is a very wise plan, because it gives you the room to go into more detail on what next.
You've heard from the Ukrainians. They want security guarantees. Did you get a sense from your meetings yesterday that the U.S. is willing to do that?
Well, the US is saying this. First, we need a peace deal / a ceasefire. And the president is very clear on this, that obviously there will be many issues to be discussed and debated when a ceasefire / a peace deal is there. But to discuss how to keep a peace deal, if there is not yet a peace deal, is also a bit strange. Of course, you have to think in parallel.
He's already taken off Ukraine joining NATO off the table. So Ukraine is left asking this question, how are we going to know we're going to have proper security?
Yeah, but he was also very clear, Pete Hegseth in Brussels, but also the president himself, that when there is a deal on Ukraine, it has to be lasting. It has to be durable. Putin should not have to try this again. So the question is then the how. How do you do this post a peace deal? Then I would side with the president. You first need to have a peace deal before you can get into these details. Obviously, behind the screens, there will be discussions on the what if there is a peace deal, how then to maintain that. But there are many ways to do that. And we know, of course, that the French...
Will NATO be involved? Zelensky's calling for a monitoring mechanism coming from the alliance itself.
I mean, there are many ways to do this, but I think for NATO to be as NATO involved will be difficult. But NATO will maybe always advise and look into what is the best way to do this. But in the end, what we are seeing now is the French and the Brits and the Brits and the Americans discussing how could you organize that. But again, I would caution a little bit that before you get in too much detail in terms of how to maintain the peace, you first need to have that deal. And it is a step-by-step approach, and one after the other. And there, I think Trump is right.
Do you think we get a deal this year? Do you think the fighting stops this year?
I'm optimistic, yes. And I know
so Peskov is cautiously optimistic. I believe the National Security Advisor, Mike Waltz, is optimistic, and so are you.
I would also be cautiously optimistic about this year, but I hope it is sooner, because the amount of people dying there, the destruction of whole cities happening as we speak, it is really very, very painful, and it is having an impact on so many families and so many people in Ukraine, but also on the Russian side. We know that there were days that the Russians were losing up to 1,500 people dying or seriously wounded a day, but also on the Ukrainian side, so many people dead and so many people seriously wounded.
Before you were Secretary General of NATO, you ran a European country. Would you be willing to do business again with Russia after this? Because we are hearing reports of things like maybe gas deals come back into play.
Well, I mean, I'm not there, because first of all, you have to maintain the pressure on the Russians to make sure that they do whatever is necessary. That's why we have the sanctions, and let's not be naive about the Russians. But longer term, Russia is there. I mean, Russia will not go away. And I've had many dealings with President Putin till 2014. In my first 4 years as Prime Minister, we had many negotiations. And I think it is normal if the war would have stopped for Europe to somehow, step by step, and also for the US, step by step, to restore normal relations with the Russians. But we are absolutely not there yet. We have to maintain the pressure on them to make sure that they are willing to engage seriously in talks with the American administration and, of course, also with the Ukrainians.
I think the markets and business leaders might be a step ahead of the leaders in this one. We have to end on Greenland, because you were in the middle of this Oval Office meeting, and the president's talking about how he wants to go after Greenland. He wants the critical minerals there. Are you concerned at any point you'll be mediating between two NATO members?
No, I know that they are in close dialogue, Denmark and the US. So I will leave it at that discussion between the two of them. But there is a bigger issue at stake here, and that is the High North, the Arctic. And this includes the US through Alaska. It includes Canada. It includes Iceland, Norway, Sweden, Finland, and Denmark because of Greenland. And I think the president is totally right in saying, and others are arguing also, the Russians rearming there, the Chinese using these sea roads, knowing that we have a lack of icebreakers. There is a reason for these 7 countries, and NATO could be somehow involved here also in terms of advising and bringing the group together, that we have to take care of our defense in the High North. So this general issue he put on the agenda, I think that's positive.
And it's something NATO will talk about this summer, potentially.
Potentially, and I think the 7 countries are coordinating, and if there is a role for NATO, we will always be present.
And we hope to see you there at the summit. Thank you so much,
Thank you so much.
Rutte. Thank you so much for joining in. His first interview of the day after his Oval Office meeting with President Trump, and made it very clear to me, Jonathan, and our audience, President Trump is committed to the alliance.
Annmarie, appreciate it. Fantastic conversation. I think it's worth framing. When Mark Rutte was the Dutch Prime Minister, we used to speak to him on a number of occasions, and he would come on the programme, he'd come on Bloomberg Surveillance, and he would say, President Trump was right. He was right to push NATO members to spend more, making that point in this conversation. Defence target needs to be above 3%. And
finally, they are responding, and he said, absolutely, President Trump did help that to happen by applying pressure. And now we have Germany potentially committing some 400 billion euros to build out the defense system.
I love the way Annmarie finished that conversation. It was the second to last question, the penultimate one. I think it's so important. If we can secure peace, that's one thing. Can we normalise trade relations with Russia? Because that's a huge ask.
There have been a number of companies that have been kind of flirting with this in off-the-record conversations. There's been a discussion about that with President Trump talking about how it would be okay. And what Mark Rutte had to say, I think, was important. He was saying, look, we're not there yet. We're not even close to there yet. But longer term, it's there. What are you going to do? Ignore it and its resources? It's going to be a delicate dance, though, and we are a long way out before that happens.
A conversation with the NATO Secretary General Mark Rutte there down in Washington, D.C. with Annmarie. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. World Liberty Financial, one of the Trump family's crypto ventures, is said to be in discussions with Binance about doing business. Sources say conversations have included the development of a stablecoin with World Liberty. According to its founding documents, the Trumps received 3/4 of the venture's net revenue. Meanwhile, Forever 21 is preparing a bankruptcy filing. Bloomberg has learned the fast fashion retailer could close all of its stores in the coming days. Sources say efforts to find a buyer have failed so far, but talks with one potential bidder are ongoing. And MGM Resorts has a plan to generate hundreds of millions of dollars in added profit through some new initiatives. The company is planning to raise ATM and parking fees, but they're also doing things like recycling sofas and even using robot vacuums. It's also begun replacing front desk staff with self-serve kiosks. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, U.S. growth in question.
We fully wear the fourth quarter, and we may well wear much of the third quarter. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates.
So that's the difference between Biden data and Trump data. I think we're all up to speed now. Up next on the programme, Erin McLaughlin of the Conference Board from New York. This is Bloomberg. Equities here on the S&P 500 positive by 0.9%, a bounce back in today's session by 1.2 on the Nasdaq. Under surveillance this morning, U.S. growth in question.
We fully wear the fourth quarter, and we may well wear much of the third quarter. For sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates.
So here's the latest. Commerce Secretary Howard Lutnick doubling down, saying recent soft economic data is not President Trump's, even after tariff worries spark concerns over economic growth. Erin McLaughlin of the Conference Board writing, "We're not forecasting a recession, but are predicting a slowing economy." Erin joins us now for more. Erin, good morning.
Good morning.
Let's talk about what your members are telling you. What are they telling you right now, and how have things changed versus where they were just a few months ago?
Our members are very, very concerned about tariffs primarily and about how to plan for tariffs. They're seeing the volatility, the change almost on a daily basis, and understanding how they're going to source their materials and how they are going to plan for the future is causing a lot of consternation.
Which raises the question of how much and how quickly confidence has dropped off. And it's not just in consumers, it's also in corporations. How quickly has it been?
It's been pretty quick. So the Conference Board is very, very well known for our Consumer Confidence Index. Our last reading, which came out a couple weeks ago, only took in just part of that 10% tariff on China. But we saw our third consecutive monthly drop and our biggest drop since 2021. Also, we have write-in responses for consumers and businesses in the survey, and tariffs was mentioned more times than since 2019, which was right after, we saw those initial tariffs with President Trump's previous administration.
One of the big challenges has been that in the past, consumer confidence in particular hasn't translated into a lack of consumer spending.
Yes.
Watch what they do, not what they say.
Right.
Is there a sense that this is different?
There is a sense that this is different because I think that tariffs and inflationary pressure has already been in existence now for quite a while, and that's sort of unprecedented. But we also know that tariffs are going to raise prices, and that middle and lower income consumers have to bear more of the weight of the tariffs. So what we're hearing from some of our members is that they're concerned that the buying will be about, what I need versus what I want. And although consumer spending drives our economy, how consumers spend, is very, very important to the business community.
Is it being influenced by political preferences? Because we see a lot of that in Mgmt. They talk about it explicitly. Do you see the same thing?
We do see it more broad-based. We haven't, we see that a little bit, but it really, really is a broad-based concern.
Get you, Mitch, again later on this morning, 10 a.m. Eastern time, and I imagine we're going to see that story all over again.
At the same time, how much do people still have to pay attention? Because just like you think about Target and some of the campaigns and conservatives buy at Target too, well, liberals buy as well. So at a certain point, you have to guess if there is a significant drop-off that could have a ramification economically, even if it is politically driven.
Erin, appreciate your time.
Thank you.
Difficult to track this economy right now. Erin McLaughlin there of the Conference Board. Coming up next on the programme, a range of guests including Ulrike Hoffmann-Burchardi of UBS, Bloomberg's Threadneedle, Torsten Slok of Apollo, and Ed Al-Hussainy of Columbia Threadneedle. The third hour of Bloomberg Surveillance up next.
Tariffs are bad for growth and bad for inflation.
We're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs.
The prospect of tariff wars that could last is very concerning.
What will be a problem certainly would be if tariffs are on the maximalist side of things.
It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We've said this a few times. February 19th feels like a lifetime ago. February 19th, all-time highs on the S&P 500. We're lower by 10 percentage points since then. And yesterday, entering correction territory for the first time in a couple of years. Equity futures this morning bouncing back, up by 0.8% on the S&P, on the Nasdaq 100 up by 1.1. Later on this morning, just a sprinkle of economic data. One important one, 10 a.m. Eastern Time. Mitch, consumer sentiment.
At a time when you've got a quickly moving economy as represented by the airlines earlier this week, just to sort of emphasize the amount of carnage that has happened, $5.3 trillion has been wiped off the S&P 500 market capitalization since February 19th on a bet of just increased volatility and risk-reward proposition. If it is met with true weakening in the underlying economy, does it have more to go, or are people kind of pricing that in?
The damage done has been phenomenal, not at the index level, beneath the index for some of the biggest names on the planet. We talked about tech throughout this morning. Meta down 20% from the highs of last month. Nvidia down 22% from its highs. Amazon down 20%. All these major tech names have been hitting low after low after low, with a bit of a bounce recently. But even Apple, you're starting to see the analysts come out and say, I'm nervous now about iPhone sales growth in the next year or so, nervous about weakness in China, nervous about a lack of AI, and that's where the focus is right now.
Yeah, NASDAQ saying to the S&P, hold my beer. I'm in actually some sort of true bear market rather than you just simply having a correction. Key question here, this is not due to some of the headline risk, and I think that's important to note. That could be part of it, but it also has to do with DeepSeek. It also has to do with valuations. It also has to do with competition from China more broadly. There are a lot of aspects to this that make it hard to understand exactly where the weakness is coming from in the broader market, given how much of a run-up we had seen in these names.
And better opportunities elsewhere.
Yeah.
Europe. In focus this morning, the German Chancellor in waiting, Friedrich Merz, coming out a little bit later on this morning, expecting some headlines from German politicians throughout today as we report that German lawmakers are coming together to make an agreement with the Greens to push forward this big debt spending plan on both infrastructure and defence.
That's the important part in many people's eyes. Not only do you have defense spending, which a lot of people were expecting, but you have a 500 billion euro aspect of this that goes to infrastructure investment, which potentially could be stimulative. And oh yeah, by the way, is also sending valuations down of German bonds, yields up. How much is this going to be the pressure that really drives some of the yield market around the world?
The additional value in Europe being built up around the potential for peace in Ukraine, ceasefire first and then hopefully a long-term peace agreement. We caught up with the NATO Secretary General Mark Rutte about 30 minutes ago down in Washington with Annmarie, who said he was cautiously optimistic we could see that later this year. Now, the next question you've got to ask is that once you've lifted that massive cloud that's been hanging over Europe now for several years, do they normalise relations with Germany and the Russians, Europe and the Russians? Is that the next step?
It feels like that's really far away. Even
Feels
Mark
like a stretch,
Rutte is
right?
saying that that's a bit of a stretch. So how much of a relief valve is that if there is peace between Ukraine and Russia? I will just say, there are these aspects that we don't think about, like Ukrainian drivers going to Poland and having to do with a lot of the shipping in Europe and actually accounting for lowering prices in the past. There are things that could open up that could help the economy with peace, even beyond just normalization of relations.
Just to check out the German debt market, German bond lower this morning. Yields are higher by 7 basis points, 293 on German 10s. Coming up this hour, lots to talk about. We'll catch up with Ulrike Hoffmann-Burchardi, making the bullish case for US stocks. Torsten Slok on the US entering a wait-and-see economy. And Al-Hussainy of Columbia Threadneedle looking ahead to the Fed decision next week, Wednesday, March 19th. We begin this hour with equities rebounding after falling into correction territory just yesterday. Ulrike Hoffmann-Burchardi of UBS writing she sees downside risk to equity markets in the short term. However, we anticipate that there will be light at the end of the tunnel as progress is made towards budget reconciliation, and we maintain a bullish outlook on the US equity market. Ulrike joins us now for more. Good morning. It's good to see you.
Thank you for having me.
Let's talk about that constructive view. We want to see that light at the end of the tunnel. When's it going to come?
Yeah, so you just referenced February 19th. At that point, we saw a big disconnect between the policy uncertainty on the one hand and the low implied volatility on the other. And we asked our clients to protect their equity exposure. But now, with volatility almost double since February 19th, and the market, as you said, in correction territory, I think it's time for some selective buying in the US. And we don't think there's the all clear yet. There's certainly still some work to go through on the economic side. But we do see, now it's at least, we think, time to focus on the light at the end of the tunnel.
How selective? Do you do that at the index level, market cap weighted, equal weight? Is it selective, sectors versus sectors, names versus names? How selective?
Pretty selective. We think that there are some profound structural trends that are not going away in this policy uncertainty. AI and electrification are two of those, trillion-dollar investing opportunities, and a lot of the stocks in these sectors have been beaten down pretty severely. So technology, as you referenced, but also utilities and industrials. And that's good hunting ground for bargains at this point in time.
Are you talking about big tech, or are you talking about some of the other opportunities that people were getting excited about? In other words, is this an index level call that's going to be driven by the winners of old, or is this going to be something different?
It's certainly more the larger cap names that have been beaten down, but I think you still need to be selective because there is going to be some more work on the economic side to work through. There is, some still dark patch to work through. We've seen that CapEx numbers are coming in quite light. If you look at the Philly Fed index, we see M&A activity now at the lows, 2-year lows. And we also have seen in a study that companies that mention tariffs are more likely to revise their EPS downwards. So again, we have to wait until we have more clarity on the budget reconciliation, more clarity on tariffs in April, fiscal policy. But I think once we know, and once companies have that clarity, they'll be spending again.
This is the difficult aspect, and this is what we're hearing from a lot of analysts who come on, and they say we're cautiously optimistic, we're starting to buy, because eventually there will be some response from either Washington, D.C. or the Federal Reserve. Somebody will pull the trigger and make some sort of buffer for some of the volatility and uncertainty. Which do you think is going to be the most important driver? Which blinks first?
Yeah, I would count more on the Trump put than the Fed put at this stage, because the Fed really doesn't have that much more room to move. If you think about inflation, it's been trending above the Fed target rate now for almost 4 years. Inflationary expectations are picking up in light of tariffs. So that's going to limit on what the Fed can do. And then on the unemployment side, given the shrinkage in the labor force, we probably won't see a pickup in unemployment that soon. So we believe the Fed is only going to cut 2 more times this year. And therefore, I wouldn't rely as much on the Fed put this time around.
How predicated is your bullish view on the idea that we will have a Trump put?
I think the easiest thing for the administration to do right now is to repeal the uncertainty tax. And that is just a function of the passage of time. The budget reconciliation is underway. And again, once we have clarity on those fronts, companies will be able to plan and invest and in CapEx, in hiring. And I think that's going to be a big game changer right now from what we're hearing from companies, which are in some sort of paralysis as they don't know what the import costs are going to be and what the export conditions are going to be.
A lot of that's driven by trade. April 2nd is going to be so important for that matter. Is that the point at which we pass peak uncertainty regarding policy? You come out with the reciprocal tariffs, they're big, whatever the number is, and then you move on. Or do we have this story that just lingers for the next several years where it's 25 1 minute, 15 the next, and 10 the other? It's difficult to plan around.
Especially because on April 2nd, they're going to come out with a list of proposals that they want to get through. It's going to face a lot of challenges. It's going to take time to get these through. So it raises a question about whether the uncertainty tax is sort of a permanent existence in an environment where that is a feature, as Annmarie has mentioned many times, not a bug.
So let's get to one thing that's been supported by that uncertainty tax, and that's gold. Gold, 3K this morning, first time ever. Now, I understand why equities at all-time highs, you didn't like them, and you like them more when they're 10% lower. You still like gold at record highs. Just walk me through why you think your clients should still have that allocation.
Well, it's always good to have a tail risk hedge in your portfolio. That's why we are still bullish on gold. There is a lot of uncertainty still, geopolitically, technologically. So we like it as a diversifier for our portfolio.
Is it a play against the
inflation
dollar?
hedge, of course, also. Yes, of course.
Is there an FX component to it? Is that what you're seeing clients do?
We think it's a combination of various factors where it's an FX component, it's a hedge component, but we also think it's an inflationary hedge, especially with tariffs looming. So a lot of good fundamental reasons still to be bullish.
There's a bigger question about whether there's a structural change underway. And the gold is sort of an example of that, where there's a move away from dollar assets more broadly. And it doesn't have to be a massive move. It's not like, debase the dollar. But it does speak to some of the growth opportunities elsewhere, like in Europe and China. How much do you buy into that idea, and how much do you reject that as maybe some idea that's gotten ahead of itself?
Yeah, so we came into the year quite bullish on some international opportunities. Asia ex-Japan, in particular China tech, we had been bullish on for quite some time. In particular, our thesis was that the China AI mode, especially the algorithmic AI mode, was underappreciated. But we feel now that that's pretty well understood by the market. We actually just took profit on both of those positions and also took profit on a tactical call on the DAX. Because, again, we came in thinking that if Merz is elected, probably Germany is going to pivot more towards a pro-growth policy. We've seen this happening. Now we're taking a pause. But we do think the policy uncertainty that we talked about for the US has not really been priced in internationally. Tariffs are not a good thing for China. They're not a good thing for Europe. On top of that, the US is going to start export controls. We have the AI diffusion regulation hitting in mid-May. That's going to restrict access to AI chips, in particular for China, further because of now eliminating the possibility of rerouting. So those are all things that the market is not enough focused on in our mind. And that's why we are now much more constructive relatively on the US.
Bank of America signaled something similar a little bit early this morning. The DAX is up again today by 2 full percentage points, a rally across Europe once more. Ulrike, good to see you. Appreciate your time. Thank you.
Thank you.
Ulrike Hoffmann-Burchardi there of UBS. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. Senate Democratic leader Chuck Schumer dropped his threat to block a Republican spending bill, meaning the government is likely to avoid a shutdown on Saturday. The two parties have been engaged in a standoff over the Democrats' insistence that a spending package include some restraints on Elon Musk's federal cost-cutting crusade. Meanwhile, Johns Hopkins University is slashing over 2,000 jobs due to the Trump administration's cuts to U.S. aid programs. The $800 million loss in funding will bring a halt to health initiatives, including HIV and tuberculosis research, with experts warning of setbacks to global public health. And the Tampa Bay Rays are backing out of a deal to build a new $1.4 billion stadium in St. Petersburg. The team was expected to partner with the city and county to build the ballpark and was facing an end-of-month deadline to commit to producing the $700 million they had agreed to contribute before now backing out. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Was that you, the baseball?
Yeah, oh yeah, big time. It's like sports roulette.
I thought you were into baseball. I thought that was your sport. No?
Baseball, Mets.
Okay,
I mean,
that's
it's a family
what the
thing.
baseball is like.
Yeah.
It's the kind of music they play.
Well, I know how you feel about it, man.
Yeah.
All right, fine, we'll talk
I'll go
F1.
to Yankee Stadium now and again just to take in the environment and
just for the food.
The atmosphere and the amazing food that they supply there too.
Have a beer.
More on that another time. Up next on the programme, the morning calls. It's bad, eh? Plus, Bloomberg Threadneedle as Tesla warns of tariff impacts, of course. Mets fan, forgive me. We'll talk about Tesla next on the programme. You're watching Bloomberg Surveillance. So the opening bell is about 1 hour and 14 minutes away, and going into that, equity futures are firmer by 0.9% on the S&P and up by 1.2 on the Nasdaq. Let's get you some morning calls. First up, Baird upgrading American Express to neutral, noting more balanced risk reward. That stock at the moment in the pre-market is firmer by 1.5%. Your second call from Stifel, cutting its price target on Carnival to 30, citing softer consumer trends. And finally, Mizuho lowering its price target on Nvidia to 168, but seeing a major catalyst ahead with the company's developer conference just next week. That stock is bouncing by 2.6%. Let's turn to Tesla, the EV maker expressing concern about retaliatory tariffs from other countries, saying any countermeasures could drive up manufacturing costs and make it less competitive overseas. Joining us now, Bloomberg Craig Trudell out of London. Craig, let's talk about this. When Tesla writes a letter, who signs it? Who's it from?
It's a great question, and in this case, nobody. So I think the Financial Times was first to report on this letter, which we should give them credit for, and they happened to quote someone anonymously saying that the reason that this letter was unsigned was that nobody wanted to get fired for sending this. This may sound a bit alarmist, and of course, Elon Musk talks about his belief in free speech. But that being said, we have seen instances in the past where people internally who have written letters that could be perceived as contradicting him or criticizing him have lost their jobs. And so that is, of course, it seems like a valid concern in this case.
Craig, wouldn't it also be valid to expect an automaker to be lobbying the government on this point anyway? Shouldn't we also expect GM and Ford, Stellantis to be doing exactly the same thing?
Yeah, absolutely. And we've heard Ford CEO Jim Farley do so quite publicly. I thought, just a few weeks back, there was a analyst research conference where, Farley talked about the idea that what we've been hearing from the administration is a lot of desire to want to help U.S. manufacturing and help the U.S. car sector in particular, and he both welcomed that and yet said, but what we're actually seeing is a lot of cost. And, this is a case where, industries don't get much more globalized than the car industry. And, in the U.S., when we sort of evaluate how much parts content is locally sourced, by law, we loop in Canada in how we calculate those figures. And, that goes back to the Clinton administration. So, going back to when that was enacted, I think it would have safely been assumed that, the U.S. and its neighbor to the north would always be on good terms trade-wise. And, that has very much been challenged in the first couple months of the Trump administration.
Craig, this unsigned letter had a lot of different components to it. One of them was potential retaliation from other countries. Some was a potential drop-off in demand, which we have seen for Tesla vehicles, anecdotally, in places like Europe. There was also this: even with aggressive localization of the supply chain, certain parts and components are difficult or impossible to source within the United States. That's really interesting, Craig. Can you speak to that at a time when we've heard this increasing trope from the Trump administration: bring manufacturing back and then you can avoid tariffs?
Yeah, I mean, I guess the simple answer to that is it's not so easy, right? I mean, I think the Inflation Reduction Act, was an attempt on the part of the Biden administration to address the fact that there are parts of the EV supply chain that just don't exist in the U.S. And, Tesla itself, in the course of the IRA being implemented, sort of took advantage of something of a loophole that, when it was being sort of ironed out how exactly some of these content requirements were going to be met, they took advantage of the fact that there was some leeway granted that allowed for Tesla to import batteries from China for a short while before the Treasury implemented rules to really sort of solidify those requirements. And so, it's not very clear from this letter what specifically they're citing in terms of particular materials or components that they say is impossible to source from the U.S., but it absolutely is the case that China dominates the EV and battery supply chain, and Tesla, very much taps into that, not only in their Shanghai production, but even for U.S. vehicles as well.
John started the conversation in the right place, talking about who signed this letter and ultimately who's running Tesla, who is ultimately calling the shots at a time when what's good for the business might be kind of at odds with current policy and rhetoric coming out of the White House. We were talking with Dan Ives, a perennial bull, and he was saying this is kind of the moment of truth for Tesla, and Elon Musk has to leave the government or his Doge office and pay more attention to Tesla, or else this is going to become a real problem. How much is that what you're hearing more broadly among Tesla investors?
I mean, it just reminds me very much of the Twitter takeover, right? And you saw in the course of that year when Musk initially bought a stake and then pursued the company on and off, tried to get out of the deal. You saw that really tanked Tesla shares, right? And early the year after he closed that deal, that acquisition, Tesla staged an event where they had something like 15 executives on stage, and it was a not so subtle indication of, look, we're more than just Elon Musk. We have this really strong bench behind him, but this is a company where, it hasn't necessarily leaned into that. That was a sort of rare instance of them, having others within the company sort of share the spotlight with Musk. It has both worked to their benefit over the years for Musk to be so synonymous with this company. I think what we're seeing lately is perhaps an over-reliance on his star power, because to the extent that his star fades, it is really problematic that when you think of Tesla, you think of Elon Musk.
Craig, let's just wrap it up by talking about the whole sector at the moment, the three big players. Could you help us understand, just give us some insight into how they're operating at the moment? I imagine they didn't just wait and do nothing, see the tariffs and then start to react. How did they prepare for this? We've got tariffs on steel and aluminum. We've got tariffs on China. Clearly, it's going to disrupt them in some way, shape or form. How did they prepare for it, and how are they responding now?
I think the sort of short answer there is it's really difficult to prepare for it when policies are changing sort of day to day and even within a day, right? And so there are some actions that manufacturers can take to try and in the short term maybe stockpile parts. I'm sure they are also looking at what options they may have to perhaps add a shift here or there in terms of the plants that they do have in the U.S. to sort of make up for any tariffs on products coming in from Mexico or Canada. But these are incremental moves, right? And if they were to go so far as say add another plant in the U.S. or multiple plants, this is a process that plays out over 2, 3, 4 years. Do you make that investment not knowing whether or not this policy will last beyond this Trump term? It's a really tricky proposition for any CEO leading a car company right now.
Craig, appreciate the update and the clarity. Thank you, sir. Craig Trudell there of Bloomberg, out of London on some of the big automakers worldwide. This is the issue you've got at the moment. I think the push is pretty clear. Secretary Besson's been very transparent about it. Rebalance the economy, do all of those things. Got it. The disruption in between, the detox you've got to go through. You can't just take one plant from one country to another and do that overnight. It takes a while to trigger that supply side response, and we've talked about that now for a number of weeks.
And you need a consistency in terms of some policy, and that is part of the issue that a lot of these companies are dealing with. In the Financial Times article that first reported on this letter, they said, citing a person familiar with the process of sending the letter, it's a polite way to say that the bipolar tariff regime is screwing over Tesla. It's not just a matter of tariffs or not tariffs. It's a matter of consistency and clarity, which is a theme that we keep hearing from, the idea of the uncertainty tax.
It's not the policy, it's the policy volatility. It's the change from one day to the next, 1 hour to the next at the moment, and that's what's complicating things. Tesla, so far year to date, is down about 40%. That's something like $500 billion of market cap. Up next on the programme, Torsten Slok of Apollo on what he calls a wait-and-see economy. What that means for the bond market with Ed Al-Hussainy of Columbia Threadneedle. That conversation just around the corner from New York. You're watching Bloomberg Surveillance. Equity futures on the S&P about 60 minutes out from the opening bell. Session highs now up by 1 full percentage point as we get set to avoid a government shutdown this weekend and open the door for a real conversation about the policy that is friendly for this financial market, and that is tax cuts. Maybe that conversation ramps up in the nation's capital over the next several weeks and months. Equities up on the Nasdaq by 1.4%. With some movers going into the opening bell, here's Yahira Hecker. Say, Yahira.
Hi, John. We start with Peloton shares. Those are up nearly 8% here after the team over at Canaccord upgraded the stock from hold to a buy. They're saying Peloton is the clear leader in the connected fitness industry because of its early investments, as well as a member base that's both established and loyal. Next up, we have shares of DocuSign. Those are up 11% now. The e-signature company delivered strong results. Bloomberg Intelligence saying the growth in billings, including 11% in the fourth quarter, stands out given the economy, because as we know, we have seen signs of business optimism falling, specifically among small businesses. And last up, we have another riser for you, and that is Ulta Beauty. It's up 8.4%. And while it was a mixed picture when it came to results and the outlook, investors seem to be increasingly confident in the new CEO's ability to navigate the competitive beauty market, as well as what they're calling consumer uncertainty. We've heard that one before, of course, but the retailer's saying 2025 is a transition year for them, and investors look to be along for the ride. John?
Stock is up by about 8%. Yohara, thank you. Thanks for this morning. That's the update on the US side of things. Better news. Let's talk about the better news taking place over in Europe as well. Euro-dollar session highs back through 109. We've reported earlier on this morning that the German government getting set to push forward some of the Chancellor-in-Waiting's plans to spend money on defence and on infrastructure as well, coming to an agreement, reportedly, with the Greens. So that's important. Let's hope that happens for the benefit of those of you that have been long European equities and short German debt for the last few weeks. We've also got this news as well from the G7 foreign ministers meeting over in Quebec, coming from the Canadian foreign minister, that ministers are finding common ground on Ukraine. This really echoes what we heard from the NATO Secretary-General Mark Rutte about an hour ago, sitting down with Annmarie in Washington, D.C., cautiously optimistic on finding an agreement around Ukraine over the next several months.
Yeah, the discussion now heads over to Russia, and a question of how much Vladimir Putin wants to agree with things or not. The initial reporting is that there is a huge asterisk around some of his asks, and there's a question of how far the U.S. will be willing to push the Kremlin to try to come to the table. If this does come through, what does it look like, and how much of a boost does it give to the euro region? And that, I think, is what a lot of people are looking at.
It's given a boost to German yields again, up 8 basis points now on a 10-year maturity, 2.93. Another line from the Canadian foreign minister. We'll keep the pressure on the United States. We're seeking off-ramps on tariffs. So let's talk about trade. Investors assessing the market impacts. Consumers and businesses already readjusting. Torsten Slok of Apollo writing, this is a wait-and-see economy. Consumers are more reluctant. The bottom line is that this eventually leads to a slowdown in the hard data, and markets should prepare for that scenario. Torsten joins us now for more. Torsten, good morning.
Good morning.
We've seen the shift in the soft data. The last time we spoke, you raised the issue. I believe Lisa asked you the question. Would that soft data bleed into the hard data? Do you sense a inevitability now towards that?
We are beginning to see that if you look at the high-frequency data. So over the last several weeks, we have seen, and I know some of these indicators are a little bit special, but we've seen the number of people who are going to movie theaters, number of people going to Broadway shows. If you look at the TSA data for how many people fly in airplanes, even if you look at how many people are visiting the Statue of Liberty here in New York City, all that has actually started to weaken. And now we get another soft data print here at 10 with the Michigan sentiment for consumers. So overall, it is still a little bit too early, but given that we have this wait-and-see situation, both for consumers and for corporates, it does make sense that the soft data should eventually begin to spill over to at least some weakening in the hard data.
One feature of this cycle that I think a lot of people underestimated, you not included, is the resilience of this economy. What is our capacity to absorb shocks now? Has that been reduced?
Well, that's a very important question because that depends on the nature of the shocks. And we're facing two shocks at the moment, namely DOGE, which is laying off government workers. Estimates suggest that there will be around 300,000 workers that might be losing their jobs. Remember that for every federal worker, there are 2 contractors, according to Brookings. So Brookings studies show that in total, true employment in the federal government is roughly around 9-10 million people. So if you now think about total number of households is 130 million, and someone in a federal worker or contractor lives together with someone in the private sector, you get that as much as 10-15% of all households in some way or another is being impacted from a sentiment perspective by DOGE alone. And tariffs, of course, also in particular impacts anyone who is associated with trade with Canada and Mexico. And you have that is also a particular, of course, across the border to the north and to the south, playing a significant role in a number of states. So the bottom line is, it's not only tariffs and trade war, it's also the combination of the risk that government workers and contractors potentially losing their jobs that are the main reasons why the soft data is weakening the way it is. And it's not only consumer soft data, it's also corporate. If you look at the CapEx planning from the regional Feds, Dallas Fed, Philadelphia Fed, New York Fed, that's showing that businesses in those districts are saying we're beginning to cut back CapEx plans. Likewise, NFIB, also roundtable surveys, CapEx planning is also moving lower. So both consumer confidence moving lower, corporate confidence moving lower. It is a precursor for a slowdown coming in the hard data.
There's an argument being made that if what was propping up the United States economy was government spending, it wasn't that strong to begin with. And this is actually somewhat of a withdrawal from a sugar high from an incredible amount of fiscal spend in the direct aftermath of the pandemic. Do you buy that?
There is some truth to the detox argument in the sense that if you look at hiring in non-farm payrolls over the last 2 years, 25% of jobs created in 2023 and 24 were government jobs. The previous years, it was like 5-10%, much less. So a very significant part of jobs in the last 2 years had been coming from the government sector. So it is true that job growth has been slowing in the private sector, even going into these shocks that we're looking at the moment.
Heading into 2025, you were pretty clear that you think that the inflationary shock was going to be maintained and that it was going to create a real problem for the Fed to actually offer a response to that kind of weakness in the economy. Do you continue to see that, even though the shocks that we're seeing right now to policy might have a bigger ramification on growth than you had previously expected?
Well, the real challenge is that going into tariffs, we had that inflation, unfortunately, was still too high at around 3%. And most calculations suggest that you will add roughly 0.5 percentage point to core PCE as a result of tariffs. So it makes a huge difference where you start. If you start with inflation at 3 and you add 0.5%, of course the risk is that you will have too much upside and we're way above the Fed's target. Whereas if inflation had started at 1.5, which is where we were in 2016, and you add 0.5%, then inflation would move up towards the Fed's target. So the problem was really that the starting point for inflation when these policies came along was that it was unfortunately well above the Fed's target. So the risk is in this situation that you have inflation moving higher and growth slowing down, which of course is the definition of a stagflationary shock.
We were talking to Mohammed Al-Arian earlier this week, and he made the point that given these dual shocks, the Fed should probably allow inflation to run a little bit hotter for a longer period of time and address the growth issues and cut rates at least once this year. Do you agree that that's more prudent at a time where there are these stagflationary forces starting to loom?
Absolutely, because the Fed has the dual mandate. On the one side, if growth is slowing, is saying the Fed should be cutting. If inflation is going up, is saying the Fed should be hiking. I think the Fed will look at if growth starts to slow and if we over the next several weeks begin to see that unemployment begins to go up. Let's not forget that non-farm payroll is always done in the week of the 12th, means this week. So this is the week when they do the survey for the employment report. And if we do believe that this week was somewhat intense on the policy front, then there is, of course, a chance that non-farm payrolls for March could be on the weaker side. And if that's the case, then in the next several weeks, and particularly going into April, and with the April 2nd deadline also from Trump with the reciprocal tariffs, we come to the conclusion that the risk is that we might begin to see growth slow down. And the Fed will say, well, as long as inflation expectations are anchored, yes, actual inflation may be higher, but if inflation expectations are anchored, they will be focusing on growth slowing down. And therefore, the risks are that markets will be pricing in more cuts at the time. And by the way, it looks like from stock markets that they are almost saying, well, the Fed should be cutting many more times, whereas rates markets are saying, no, we only need 2 more cuts. So there's almost an inconsistency between the messaging from stocks that are now in correction territory and rates markets saying, no, we only need 2 more cuts.
In the news conference on March 19th, next Wednesday, how does Chairman Powell address those issues? What are you looking for?
So I'm looking very much for how much he's focusing on the soft data slowing down. He did do that at the US NPF last Friday here in New York City, where he was in his prepared remarks saying, everything is generally okay. But when he was sitting down with Anil Kashyap and asked questions, he was more saying, hey, something is going on that has some downside risks that we maybe should be putting more weight on. So I do think that he will begin to talk about, well, there's softness in the soft data, but maybe we're also worried about softness in the hard data.
We have seen this incremental shift from the November meeting into December. We don't assume, we don't guess, we don't speculate. Then in December, there was some assumptions, some guessing, some speculation. And then I agree with you. The recent address we had from Chairman Powell, there was another subtle shift. Just started to tackle policy issues head on in a way he hadn't done in the previous few months.
And on some level, he kind of has to, because there is a sort of scenario analysis that has to come from the Fed for them to even be relevant about how they're measuring some of these aspects. And that's probably why the Statement of Economic Projections, which could be a dartboard, but is sort of a messaging tool about how they're going to potentially respond to what is transpiring in policy and how it's transpiring in data, even if it doesn't necessarily come to full pass.
The difference now, I guess, is we're actually getting the policy. They don't have to speculate about it anymore. But that policy comes with a lot of volatility. And Torsten, they've got to manage interest rates through the cycle. Maybe Chairman Powell steps down in the next couple of years. I imagine he will. I don't know for sure, but I think we all think he will. I want to understand from that perspective, you sit there and you acknowledge the risks right now, but also you've got to think about tax cuts, the potential for looser regulation further down the road. How do you manage through the cycle with that in mind?
Well, that's why this debate about is it policy dependent, is it data dependent, becomes really, really important because, of course, the policy that's in place suggests that, well, so far the two things that we have seen from the beginning is DOGE, which is putting the unemployment rate up, and also tariffs, which is putting inflation up. So if that's the case, they need to deal with that shock as the first thing, even, as you say, if there are other policies coming on deregulation, on lower taxes, and potentially also more energy production.
Torsten, Clinic, as always, good to see you, sir. Looking ahead to next week, March 19th for the Federal Reserve, next Wednesday for that meeting, including a news conference and forecasts from the chairman, Jay Powell. Torsten Slok of Apollo. Another read on the US economy coming up a little bit later. UMich consumer sentiment crossing at 10 a.m. Eastern time. Got some data through next week as well. Bloomberg's Mike McKee joins us now to break it down. Morning, Mike.
Good morning, John. Well, Torsten was talking about consumer confidence as a sign that maybe we'll see some reaction in the hard data going forward. And we do have an expectation for a decline again in the Michigan consumer sentiment numbers and a rise in inflation forecasts from Americans. But is that really going to translate? We'll find out Monday because we get retail sales. Although these are February numbers, and so the question is, are they reflecting what's been going on in Washington and the new policies of the administration? That's the Fed's dilemma, and we'll be talking with Jay Powell about that, obviously, on Wednesday. Do they have enough information at this point to give you a valid summary of economic projections and a valid dot plot? The Fed officials I've talked to say not really. It is more like Lisa said, a dartboard at this point, because they're still waiting to see how big the tariffs will be, who they'll be on, and how that feeds back into the U.S. economy. So we're still kind of up in the air. And while we will get some hard data next week, it doesn't necessarily reflect what's been going on so far.
Mike McKee on the latest. Thank you, sir. Looking ahead to the data later this morning and the Federal Reserve next week. Need to talk about this right now, developments over in Germany. So the so-called Chancellor in waiting, Friedrich Merz, holding a news conference right now and indicating the CDU, the SPD, the Greens have reached a deal on a fiscal package and giving some details on what that deal actually includes. A special fund for infrastructure of $500 billion. The infrastructure fund is only for additional measures. Getting some details from them in that news conference taking place right now.
Which is the reason why a lot of people are hoping this actually does boost growth, and the reason why you're seeing that type of move in equity markets, but also in bond markets. This is clearly a new German regime where they appear willing and able to get some sort of spending package through. We are seeing German 10-year yields at the highest levels going back to 2023 and rising further.
Yields are up by 7 basis points. It's quite a move we've seen. Ed Al-Hussainy of Columbia Threadneedle writing on the global fiscal outlook shifting. Tariffs and DOGE shock have had no meaningful impact on the real data so far, but policy uncertainty is likely to continue as long as administration struggles to define wins. Ed joins us now for more. Ed, good morning. Good to see you.
Good morning.
All these details coming out from the US side of things, the European side of things, and stuck in between is the Treasury market. What drives what? What doesn't drive what?
Look, I think we can only focus on one thing at a time in the Treasury market. And the focus so far this year has been a reassessment of growth. And it's been a clear reassessment to the downside. We started the year with growth expectations really nailed to the ceiling. And now I think there's just a broader range of outcomes that's in front of us, and that's what's in the price in Treasuries.
We were just talking to Torsten Slok, who said that right now Treasuries are pricing in maybe 2 rate cuts, saying that's all that's necessary, while stock markets are suggesting a lot more is needed. Who's right?
I think the answer is always they're both pricing the same thing. It's very rare that markets diverge in such a way. We just started from different points. We started from a point where Treasuries were relatively cheap. Stocks were quite expensive, and we've re-rated down, right, about 10% down in terms of stocks, 70 basis points in Treasuries. We're roughly in the right zip code at the moment. And I think, to Thorsten's point, right now the market is waiting to validate some of these expectations, and the expectations are, frankly, a little bit on the negative side.
In terms of growth, in terms of just what we could see going forward. I guess what struck me, and I've been thinking about this the whole week, that a lot of the people who are bullish on risk assets have confidence that there will be some put. Either it will come from Trump or it'll come from Powell. Either someone will come to the table and rescue sentiment with either some sense of certainty or a rate cut. Do you believe that? Do you think that one is sort of more likely before the other?
I have good news and bad news. The bad news is there's no put. The good news is that from an investment perspective, high-quality bonds have done a really good job of buffering the drawdown in equities. There's always this outstanding question, in an environment where there's more inflation uncertainty, higher inflation risk, will bonds play that role? And we've just had a 10% drawdown in equities. Bonds did a fantastic job of buffering against that drawdown.
Not this week, though. Totally unchanged on a 10-year yield, and the equity market's down 4%. What's that about?
We front-loaded a big chunk of the move. We had 70 basis points in terms of 10-year yield that's come down. We're now, again, kind of trying to figure out, does it make sense for Treasury yields to move lower? That would be validating a quite negative outlook, and it's not in the data at the moment.
Do you think developments elsewhere are complicating what could happen with Treasuries? And by developments elsewhere, I mean Germany. And this headline crossing just moments ago on the Bloomberg terminal, that the Greens party is backing the fiscal reform plan in Germany that the Chancellor in waiting, Friedrich Merz, is driving forward. Now, he also says the fiscal discipline remains important. I understand in Germany you've got to say that when you do things like this. But this is a massive change in Germany, and bond yields have been flying there. What does that mean? This is a global bond market. What does that mean for Treasuries?
You know, it's been striking that the spillovers from Europe back into the U.S. have really been quite de minimis so far. There is this beginning of a fiscal conversation in Germany that's quite aggressive. I don't want to run away with it. The market is making the assumption that, one, it's really going to constrain the European Central Bank in terms of further easing. Two, it's going to be growth positive in the short term. And we've learned that spending on defense and spending on infrastructure takes a really long time to percolate into the economy. Those multipliers tend to be quite low. So it is a massive shift. It's a generational shift in the way Germany deals with debt. But I also don't want to run away with it.
Would you buy this 10-year here at 2.92? Does that make sense in Germany yet?
I would say not yet. I think I want the market to get a little bit more excited about growth. We're in the early stages. I like for things to overshoot a little bit more. We had that in the U.S. at the end of last year. I don't think we're quite there in Germany yet.
Do you think it becomes problematic for the periphery, where yields are also moving higher? I guess we could point to foreign exchange and say the euro and the stronger euro is validating the fiscal expansion. We're not worried about that right now. But how do you think about the rest of Europe, the south of Europe?
I actually think it's a little bit more problematic for the core. Europe has been in this unusual environment where peripheral growth has exceeded growth in the core significantly in the course of the last couple of years. Spain, Italy, Greece, they've seen fantastic levels of growth driven by services. In the core, we've struggled particularly with manufacturing, which is highly interest rate sensitive. So we are not yet at a stage, but we need to have this discussion around higher rates are going to put a dampener on growth in the manufacturing sector. A stronger euro is going to put a dampener on growth in the manufacturing sector. So there are going to be significant offsets to this fiscal stimulus up front.
Yields are up this morning, that's for sure, up by 7 basis points over in Germany at 2.92. The brilliant Al-Hussainy there of Columbia Threadneedle breaking down the global bond market today. German bonds lower, yields are higher. German politicians coming to an agreement. They'll have to vote on this on Tuesday, I believe. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. So, Yahara.
Hi, John. The Trump administration is tightening sanctions on Russia by restricting payments for energy, even as it pursues a peace agreement between Russia and Ukraine. The White House did not publicly announce or acknowledge the change, which was put in place by the outgoing Biden administration. And we mentioned this story earlier, but worth repeating, an American Airlines plane caught fire at the Denver International Airport. The Boeing 737 made an emergency landing due to engine vibrations, then caught fire while taxiing to the gate. 172 passengers and 6 crew members were safely evacuated. 10 people suffered minor injuries. And Comcast is expanding its partnership with the Olympics. The two have agreed on a deal that extends NBC's media rights for the games through 2036. The $3 billion agreement also elevates Comcast from a media rights holder to a strategic partner. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the week ahead. We'll give you a sneak peek of next week. The headline, though, Chairman Powell, Fed decision March 19th on the Wednesday. And we'll speak to Annmarie in just a moment. From New York City, this is Bloomberg. The opening about 37 minutes away. Equity futures positive by 1 full percentage point on the S&P. On the Nasdaq, bouncing back by 1.3. Here's the trading diary through today, through the weekend and into next week. 10 a.m. UMich consumer sentiment numbers. 12 p.m. President Trump signing another round of executive orders. Later on today, the Senate voting on the spending package. Sneak peek of next week. Retail sales on Monday, Wednesday. The main event, a Fed rate decision and Chairman Powell news conference. Let's touch base down in Washington, D.C. with Bloomberg's Annmarie. Annmarie, can we go quietly into the weekend?
I think we can now that at least the government's not going to be shut down. But I wouldn't say anything is quiet, especially with Donald Trump back in the Oval Office. Maybe you can expect a few trade headlines. Remember, Jonathan, it was just yesterday that he talked about 200% tariffs on European wine, cheese, and champagne. And I spoke to Mark Rutte, the NATO Secretary General, about this, all this angst in Europe because of the trade story. But there's also debate on whether or not Trump is actually doing more for Europe when it comes to defense. And we're seeing that play out today, with Germany seemingly having an agreement when it comes to spending. And Mark Rutte made it clear to me that his conversation with Trump yesterday, Trump is committed to the alliance and that he's actually helpful and an asset to pushing the Europeans to be able to defend themselves and spend more.
Annmarie, appreciate the update. Annmarie, thank you. We've said this a few times on this programme, Bramo, that ultimately the president might push the likes of the Europeans to do things that are good for them.
Which is what we just saw in terms of this proposal that was agreed upon in Europe, in Germany. This includes earmarks for certain projects, I assume, for the Green Party, like 100 billion euros for already attributed green funds and other things as well.
I think we'd all like to go quietly into the weekend. Let's try and make that happen. Coming up on Monday, Jonathan Stubbs of Berenberg, Henrietta Trays of Vader Partners, the OECD Secretary General Matthias Gorman, Neil Dutter of Renmac, and a whole lot more. From New York City, have a brilliant weekend. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. Defending champion Iga Swiatek continues to rewrite the history books. The five-time major champion clinched her 10th straight win at the event with a comfortable victory over Qinwen Zhang. The former world number one becomes the first woman to ever reach 4 consecutive semi-finals and just the third to win 3 back-to-back quarters.